Branch admin, please mute everyone.
We still have registrations going on, so there's some inquiries on that. Shall we start the session?
Yes, Priya, please.
Yes. A very good afternoon to all of you. A warm welcome from Chengalpattu District Branch of SARC of ICAI. We are on the fourth successful day of one-day seminar on corporate laws. I request Geeta ma'am to suggest the topics for the day and take over the session.
Thank you, Priya. Good afternoon, friends. On behalf of Chengalpattu District Branch of SARC of ICAI, I welcome you all for today's session. Today's topic is Caro 2020 Corporate Governance Role of Auditors. The learned speaker is CA Vivek Krishna Govind from Cochin. Today is the fourth day. We have already had 6 sessions, successful sessions with more than 100 participants for each session. The topics are so important. Today's topic is also so important, friends. I invite our MC member Ravichandran to introduce the speaker, CA Vivek Krishna Govind. Over to Ravichandran.
Good afternoon, everybody. Today, I'm very happy to invite our new speaker, CA Vivek Krishna Govind sir. And about our sir, he is a senior partner of Mrs. Verma and Verma Chartered Accountants with more than 20 years of experience. He is qualified the CA final exam with the ICAA award for the highest marks from Kerala. And he also qualified the Certified Information System Auditor conducted by ISACA USA. He also served as the president of Kerala Management Association for the year 2017 and 18. He held the position of chairman of the Ernakulam branch of Institute of ICAI during the year 2010 and 11. He served as chairman of Young Indians, a sister organization of CII in 2015-16. He was also nominated to the top 50 youth icons of Kerala. He is also represented India at the G20 summit at Istanbul in 2015. He is also a charter member of TIE Kerala. He also served as the president of Rotary Club of Cochin Downtown and as the assistant governor for District 3201. He also served as the vice president of Kerala chapter of the Information Systems Audit and Control Association. Sir also been nominated member of the Kerala State Council of the CII. He also served as chairman of SICASA of ICAI in 2007-8 and also in 2009 and 10. He also served as a visiting faculty and associated with various premier management schools in Kerala. Sir also is a governing council member of CanCure Foundation, which provides aid for cancer patients. Apart from that, Sir also won district level and state level table tennis tournaments. And he also keenly interested in music, movies, books, travel, sports, and cultural activities. And we are very happy and we are very proud to be part of our Chengalpattu team. And we are happy to invite you, sir. Thank you.
Thank you. Thank you. Thank you so much to all of you, all the most distinguished, respected office bearers of Chengalpet branch, and to my friend Sripriya. Let me thank all of you for giving me this opportunity for being here and to meet all of you. We are in the virtual world, and so it's certainly very convenient for all of us to be sitting across a screen and speaking to each other. But I'm sure at some point I will also get an opportunity to come and meet all of you in person, because that is also certainly important for all of us. So, topic selected has been something which is very, very relevant, and I also had a look at all the other sessions which you organized over the the change seminar series which you're organizing. And I would request all to be kindly muted, because especially when I start my presentation, I would hope for that. Otherwise, there would be disturbances as we move. So it's very nice that you're able to organize, and from what I understand about the branch, it's a relatively new chapter, but very, very obviously very vibrant, and the enthusiasm and energy was palpable to me even in the first few minutes before I commenced this session. So it's really nice to see this, and I'm sure that during the course of this discussion also I'll try and have time till 3:30, so maybe around 60-70 minutes I will speak, and at that time, if anything that you'd like me to pause, or we can just make this a very, very interactive session if we want to, or we can alternatively have your questions in the chat box, and to the extent possible I will try and clear. This is an evolving topic, something where the none of us in this room would have signed a Caro 2020 report for large entities probably. By now, some of the listed ones we are almost there, getting close, finishing it, etc. But very, very few examples of live cases. Large listed companies and some of the other entities which are subsidiaries of large listed companies, we've completed the audit and closed out the initial Caro. But that's the first year that we are doing it. So there will be so many. We are already encountering a lot of practical issues as we discuss Caro 20. So I'm sure that most of us here would be, really having to apply our mind on it, because we are in May, and within the next few months, in the next 3-4 months, all of us will be, signing large number of Caro 2020 reports. So it's important that we understand, and it's also good if we can interact. If there is any point which, when I'm speaking to somebody else here as a practical perspective, or if you have seen something in the last 1 month, if you have issued any report and you faced any practical problem, that would be excellent. It would be good learning for all of us. I can share some of what we have seen over the last 1 month, and because that's all that we've been. It's applicable only from this from the previous financial year, and for reports issued after 1/4/22. So this is a topic which is piping hot right now, and we are all in the midst of finding solutions on some of the very, very critical questions which are in Caro. So with your permission, I'll just share my screen and go through a structured presentation so that it will help me keep time, and I hope that my presentation is visible to all of you. Yes?
Yeah, it's visible.
That's clear now, right? Okay. So the topic, it's very interesting. Again, it's not just Caro 2020. We are also going to talk about corporate governance and the role of auditors, and not just from a Caro perspective, but even otherwise, what is the evolving role of auditors, and why we are here. So let me start by setting some context. I'll start by first talking about the governance angle and the role of auditors. Then we will go through Caro 2020 clause by clause, where, especially the newer insertions in Caro 2020, I'll spend a little longer. The old provisions, I think I need not spend.
June month first week call பண்ணுங்க. So நான் அதுக்குள்ள இந்த 26 AS update ஆயிடுச்சுன்னா ரெண்டு பேருக்கும்.
So the reason why we are sitting here and discussing on a peak audit season for all of us, last few days have been very, very hectic for some of us. Just last night we signed off on one of the large listed banks, and so over the last probably 2 weeks we've all closed out a large number of bank audits and listed audits for those of us who are handling those assignments. So even as we sit in that difficult position right now in terms of an audit space, what we must understand is that the expectation from auditors is now sky high. There was a time where our profession had a lot of respect, and where our profession, you could walk into a room and say that you are a chartered accountant, and then, the kind of respect you would get. I remember even my early days in profession, probably, I qualified in 98, and, almost 25 years now in profession. And even in my early days, I've seen when we are making presentations in the audit committees and board meetings of companies, the respect and the regard and the manner in which the auditor is perceived was with so much of respect, and with so much of, we carried that respect wherever we go. When we are when we are in boardroom sitting with independent directors and all of that, they know if there is an issue and we say that, they will immediately, no, auditor has seen it, statutory or internal, either way. They will say, no, they have seen it. They're leading firm here and they have seen it, and they have, they are saying that this is the position on it, we accept it, and so on. But the post Satyam world that we are all living in for the last dozen odd years, world has been slightly different, and starting with Satyam and thereafter many more. There have been so many scams, and we've seen the ILFS and DHFL and all these things. Though I was not obviously not part of the audits of any of these companies, but I've had to see it from the other side, because we have been central auditors of some of the very large banks, and all these banks, virtually every bank in the banking system in India, the large ones at least, had exposure to these accounts, be it ILFS or the ILFS subsidiary IPNL or DHFL, and all that. The amount of hit that the banking system had to take because of some of these large accounts is unimaginable. Or Videocon or Bhushan Steel, or these are large, very large accounts which have gone under the radar, and continuing to more so. Future Group that we are talking about, quarter on quarter, even when banks are looking at reviving, and even otherwise we are living in a very difficult world. 4-5 years, the entire scape of the global scape and the Indian perspective has completely changed post demonetization, followed by GST, followed by issues in certain localized. Now, a place like Kerala, we've had to go through floods. There are some other states which have had to go through various other natural calamities, and 2.5 years of this virus, which has completely shaken up things. The entire MSME sector has gone for a toss, and we're living in a very difficult world right now, which is why the importance of the auditor is now sky high. Now, the problem is, unfortunately, the way in which the auditors have been perceived, because when we again sit with some of these independent directors, or when we are in boardrooms sitting on either the auditor side or sitting as directors on the other side, or when we are with the regulators, they are now looking at auditors with some degree of, there is an expectation gap. They are, okay, are auditors living up? Forget the old definitions. Nobody's, talking about bloodhound and watchdog and all that. Some of us who are, studied in the 90s, we would have always had those definitions. I even wonder if these are still there in the ICAI study material now, because expectations are now through the roof. An auditor is, have the way in which we are seen is that if there is a problem in the system, we must find it, and we must identify it, and we must bring it to the attention. Irrespective of what we may say, that we certainly we need to protect ourselves, and we're doing that by saying reasonable assurance, true and fair, and all these are words which we use, but these are not words which regulators are understanding. These are not words which, if there is a fraud, then it's the enforcement directorate or the policeman, or they are the ones who are talking to the auditors, and they don't understand what is reasonable assurance and virtual assurance and full assurance, and they don't understand true and fair and true and correct and all that. They don't understand the difference between all this. Simple question is, there has been a fraud. And being an auditor, you are part of the system. An auditor has to do it. This is the way in which the profession is today being seen. Any fraud in the system, auditor is being seen like part of management now. That's unfortunately the situation now. Which is probably why, because of this expectation gap, that is what has led to the revision in this whole Caro. We were all quite happy in 2016. 2015 is when 16 is the Caro, but the approved in 2015 or so. It actually brought down the number of clauses. It brought down from the earlier Caro, if you look at it, to the 2016 Caro. So we thought it's great. It goes to show some kind of confidence in the profession that okay, you don't need to report all that much. So many things were taken out and all that. Now from there, in the last 6-7 years, there have been so many large frauds which have come in, partly because the government also tightened its machinery. Government also found, now for those of us who are part of bank audits, you would have seen when you do, especially the central audit angle, you would have seen that in 2015, 16, 17, that period, there was something called an AQR, which was done by RBI, wherein they went to all the banks and all the restructured accounts and accounts which have been given special dispensation and kept in cold storage without classifying these as NPA. What they did is that they just withdrew all the dispensations given and it got classified. They also tightened the way in which the inspection and the Reserve Bank reviews were done. And they spoke at every meeting, and they also ensured that auditors should also follow the same line. And over a period of 2-3 years, the NPAs in the system went up 3-4 times. Sorry, just give me a second. Let me just mute my phone. Yeah, I'm sorry. I'm audible, right? Hello. Am I audible to all of you?
Yes, sir.
Yeah, okay.
Yes, sir.
Network thing. So then what has happened when the NPAs went up, 3-fold, 4-fold, the NPAs have gone up, then there is an issue. So again, finger gets pointed back to the auditors. So these are all reasons which have led to Caro being completely revamped. And I'm bringing all of this into the context of our discussion here, corporate governance and Caro. These are the two things we are talking about. So I thought I must have some background to the whole thing before we get into the clause by clause. Now, why are we here? Why? It's because of situations which have created discomfort to the regulator and to the user of the document. Things like last minute auditor resignations. I read a comment somewhere by the SEBI chairman saying there has been almost one resignation a day over the last 1.5 years. When you look at it, what he's saying is there have been more than 500 auditor resignations over 2 years, which is no joke. See, 500 auditors, when SEBI says it's going to be listed companies, we are not talking about any SME companies here or some small partnership firms, or we are not talking about audits like that, where for whatever reason audits are moving from one audit to the other. We are not talking about audits like that. We are talking about audits which are under the SEBI purview, listed audits. 500 resignations in 2 years is huge. So why has that happened? There are reasons. Is it because did they resign before some investigation or something came up, or during that? Or large number of forensic audits are happening these days. Just when the forensic auditor starts, you will see that the auditor is resigning. Or just when you find that somebody in management, there is some pollution or some problem, or let's say an internal auditor or some other some other inspection related or concurrent auditor comes up with an issue, and immediately the auditor is resigning. So is the auditor resigning because the auditor is not able to handle it? For professional reasons, you can resign, obviously. You've taken a 5-year appointment, but after 3 years, you're not able to, for various reasons, especially because some new limits have now come in. You can handle only 4 banks and 8 NBFCs. So many of our firms have had to resign from some of the audits, especially NBFCs, because earlier there was no cap. We could do as many NBFCs as we want, but now from last year they brought it to 8. So then those are reasons, regulatory reasons you can resign, or for professional reasons, the partner is not able to handle it, not able to, not able to find the time, or not having the right kind of resources. Professional reasons are different, and reasons beyond that, where because there is some discomfort which is originated from the board and the director is resigning, there is a problem. So this is something, and last minute auditor resignation. That's word last minute, you must note in that. It also means that the auditor has done the audit, completed the audit, just before signing the auditor resigns, there is an issue. So that's one reason. Fund diversion and evergreening of loans. Now again, let me come back, because one of the main, this whole system in the economy, if you look at it, who has suffered as a result of these companies, having fraudulent transactions, or directors making the money and disappearing, who has really suffered? It's the banks. Because most of these people have operated out of borrowed money, be it the Nirav Modi's or any number of names. I'm not really getting into names here. What happens? They borrow 10,000 crore, 15,000 crore, and then it just goes NPA, bad, first classified as substandard, and then D1, D2, D3 loss asset, and no proper collateral and 100% provision. And who suffers? Who finally, in whose P&L account is this hit being taken? It's in the P&L of the bank. Large public sector bank, okay, it's part of the government, so it's into the government, the larger scheme of things, etc. But not all loans are from public sector alone. Large number of private banks, and banks go bust. What has happened with something like such a large bank like Yes Bank, be it Videocon or DHFL, or what is the point finally arresting the MD of Yes Bank? He's in jail. The DHFL MD is also in jail. Money must be sitting in some Swiss account or some Antiguan account somewhere. Eventually, all these people will come out and once again live like kings. The money has already been transferred out of the country. It's sitting somewhere else. So these are things, and hasn't been reported anywhere. If you look at the balance sheets of any of these companies, or the audit reports of any of these companies, any of these things report. What happened with ILFS? Every bank in the country was after them, requesting them and pleading with them to have an exposure with the bank. I've had bank managing directors tell me that they are trying so hard to get an appointment there with the ILFS MD, but they're not able to. They do not want to see anybody sitting. That's the kind of that was the kind of situation. And then evergreening of loans. What is happening? Bringing in just before an account turns NPA, some related party loan will come in, or some new ad hoc facility will be given by the bank, or some other fund comes in to just basically rolling money. So the books, it will be kept as standard, but really no money comes into the system. On 30th March, a new facility will be given, and account will become standard. Everything will be serviced, interest, everything serviced. 2nd of April, that money would be paid back, taken back. So this is what is happening. So this kind of evergreening is happening. The going concern itself, was it really being tested the way it ought to be tested? We have an essay on it. I'm not getting into that. Similarly, CSR, a very important pillar of today's overall landscape. As auditors, are we doing anything? Are we commenting on it? Are we reporting on it? It's a very big area now, and it's a very big opportunity for us. Again, as fellow professionals, it's a huge opportunity for us. CSR, how the funds are utilized, and we actually, not just that the statutory auditor has to do this in the Caro, but at the end of the day, the statutory auditor has to do this. Someone else, so if we are statutory auditors of an entity like that, we should ideally tell the management to engage somebody like we insist on internal audit. Similarly, either the internal auditor or let somebody else independently look at entire utilization. Large companies are doing projects, ongoing projects worth crores, hundreds of crores, sometimes thousands of crores. How do you expect a statutory auditor to sit and certify on that? So somebody else has to do it, and we can place reliance to some extent on the work of another expert and independently have some checks and balances to look at it, but we can rely on the work of an expert there. Similarly, the next point is the role of internal auditors. The earlier Caro, we had to report that internal audit system is commensurate and all that. 2016 Caro that was taken out. That should have been there. So we saw that in some places, at least, suddenly the role of internal auditors became the way the board sees it is no longer a statutory. Otherwise, the statutory auditor would insist we must see the internal audit report of somewhere the importance for the internal. In fact, the importance of an internal audit came in when it found a place in the audit report, and to some extent that got diluted. So it's great that that has been reinstated. Related party, very, very dangerous area. This is where all this is happening. Large number of frauds are happening through the related party route. And fraud and whistleblower complaints. Again, this is something very serious. This is not something that we need to, sometimes what typically happens is that audit, because that's an area which we all know and which we are also, passionate about. We're all sitting and doing everything, the end of account, we look at it, verification, we do all the vouching, we do all the analytical review, GP, NNP repo, and the cash flow management and the yield and all of these things we put our head and this thing, and somewhere the same seriousness is sometimes not coming into the audit report. Audit report is the last document which is, which is compiled by the team. After the audit is over, after everything is over, the board meeting and all that, everything is, entire focus is balance sheet, get it, everything done, finished before the meeting. Audit report is all, as in last year, many a time. Checklists are there, program sheets are there, and sometimes without any mind application, people will write in the checklist, yes, 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 no, no, not applicable. Very, very dangerous. My request to all of you this year is let's reverse our work methodology. Let Caro be an audit itself, at least till we are comfortable with the clauses. Once we are comfortable, then okay. Then we can to some extent rely on the previous year review and all that, but nevertheless, it would still be ideal that every year a very detailed exercise is done upfront before, if that needed. We don't really need to wait till the end of the year and all that for checking most of these clauses. We don't need to think that this can be compiled only towards the end of the audit. This can be done anytime we will. So that's the importance of Caro. I just wanted to bring this to the attention of everybody and get all of us onto the same thinking space that Caro has come in to enhance the corporate governance from the perspective of regulators and the users of the document. And for us as auditors, it has actually strengthened us, because we are now going to go into an audit committee and say and insist that things should be a certain way. Because if we write a negative comment there, you are going to face the music from SEBI or from ROC. So we need to very, very clearly convey this to the director board, to all the directors, whether they understand facts or not. Put it out there on record saying that you are really going to, have to face the consequences if we are going to write anything that is negative in the audit report. And negative in the audit report does not just mean some qualification in the audit report. Any discrepancy that we may report in the Caro is also hereafter going to be viewed very seriously, because regulators, banks, everyone's going to look at it. Because that's the reason why some of these clauses, we did not have a clause earlier on fund diversion. We did not have a clause earlier on having to report on more than 10% variation in inventory or so many things. Now Schedule 3 has also changed. The reason why Caro was deferred is to ensure that Schedule 3 is also in line. Schedule 3 is also in line. So we must also understand that all the elements of Schedule 3, I'm sure the sessions are covering all these, so really not having the time to get into Schedule 3 amendments here, but those are very critical, and these go in tandem. So have to be taken very, very seriously. Disclosure in the financials and Caro is an area where maximum time has to be spent. As much of time as our team spends in terms of vouching and preparation of financials and finalizing the financials and analytical review, we may probably need to spend more time on ensuring that disclosures are in place, be it Schedule 3 or all the notes which require to be disclosed. So thanks to the internet, we have access to the best of financial statements in the country. So please pick up some of these, which are, if you're doing an Ind AS compliant company, download a few which are Ind AS compliant and ensure that you're going with it, have our own understanding, but also look at some of these templates or other financials which are available. That will really ensure that we are moving on track. Now, quickly moving on to the Caro. What has been the background for Caro? NEFRA, again, since we are talking about Caro, it would be incomplete without really. Why has NEFRA come in at all? And NEFRA has come in because government felt that they need another regulatory body, and the powers of NEFRA are every day being enhanced. So we must also understand that today, above us, we have another body there. So we are doing a large audit. We had a peer review, which is by our own fellow friends. So even if there is some problem, it is only a recommendatory suggestion, unless there is something really serious in it. But otherwise, peer review happens in a very relaxed environment. Then there is Quality Review Board, QRB, which is basically for certain audits. The team comes in, and we had, for one of our listed banks, we had 2 very senior chartered accountants come and sit in our office for 3 full days. 3 days, 2 senior chartered accountants reviewing 1 audit file. You must understand. So that is the depth to which it goes, and very, very good suggestions from both sides, and a lot of it was very, very helpful, the QRB. Now, NEFRA is a completely different ballgame together, sitting up there, a whole regulatory body. So we must keep all these in mind, and this is the background in which Caro has come in, and in consultation with NEFRA has come up with Caro, and the applicability has been deferred a couple of times, and now we are sitting in a time and space where it is applicable. 21 clauses and 37 subclauses. Let me tell you, it's a very large document, and the applicability remains the same. The category of companies to which it is applicable. Just to quickly remind all of us, every company, including a foreign company as per Companies Act, have to follow the Caro, except banking company, insurance company, NGO type of Section 8 companies, one-person company, small company, private limited company, subject to certain conditions which are listed here, not being a subsidiary or holding company of a public company, paid up capital, reserves and surplus not more than 1 crore as on the balance sheet date, not having total borrowings exceeding 1 crore rupees from any bank or financial institution at any point during the financial year. At any point during the financial year. Please keep that in mind. Do not look at a 31-3 position and take a decision whether you need to give Caro or not. Any point of time. In each of these sentences, let me once again remind, all of us are professionals, and probably when we were studying, we would underline some of these sentences, put a highlighter on it and focus, because we get some extra marks there and all that. I think we'll have to all go back to that mode when we are studying Caro here. We have to the fact that we are all assembled in this room, more than 100 of us on a working day afternoon. The fact that we are all here just goes to show that these are things. Oh gosh, I'm seeing some lines coming up on this, and I'm not drawing it. This is not drawn by me, let me assure you. Somebody else is drawing, so I would request the marker to be turned off. So yeah, so this is the line. Now, not having a total revenue as disclosed in Schedule 3 to the Companies Act exceeding 10 crore rupees during the financial year as per the financial statements. Now, what has been the evolution of Caro? If we look at it, we had the Mao Caro 1988. Some of us who were studying in the 90s, we would have studied the Mao Caro, and we would have applied the Mao Caro in the audits there. The manufacturing and other companies audit report order at that point, but then it was so general. I heard one of our past presidents, Amarjit Chopra ji, once say, Mao Caro was actually mild than other company auditors report. I remember him saying that many years ago. So it is so mild, what is mentioned in it, because very general. We could write sentences like fixed asset register is in the process of being compiled, or fixed asset register is in the process of being updated, and all that. We could get away with it. What does that even mean, frankly? If an asset register is in the process of being created, then how can you even say that we are convinced about the location and the recording of assets? When in one line you say it is in the process of being done, and in the second line we say that we are comfortable with the location and tagging and all of that. So it just didn't make sense, but that was the requirement. So it was very convenient for all of us. All of these things have got tightened up over time. 2003 had 21 clauses with 18 subclauses. And you, as I told you earlier, when it came to 15, 16, it actually got, it really shrunk. We're talking about 16 and 8 subclauses altogether, 24 if you look at it in clauses. And then what has happened now? We are talking about 21 main clauses with 37 subclauses. And from what I understand, initially during the MCA and NEFRA with the ICAI council member discussions, they wanted 88 subclauses is what I'm told. Thankfully, our fellow members in the council were able to convince them and bring that down to a more realistic. Otherwise, all year round, we would be sitting and only writing the Caro. We wouldn't have the time to audit it. And in fact, what I heard is that initially they wanted something along the lines of an LFAR. In banks, we do that, right? We have an audit report and we have an LFAR over and above that. Here, in a regular company regime, we have the report, we have the Caro, and we also have the IFC. So thankfully, they were able to convince that, okay, many of these control issues that they're talking about are part of IFC, so it need not find a place in the Caro, etc. And to that extent, I think we are today in a regime where we are living with this new Caro. Certainly, as we read, we will understand that some of these clauses may probably require a revision. Some of these clauses would require some clarification because it's a new document which we are doing. So probably in another year or two, it may evolve once some of the practical issues are brought to the attention of MCA. Now, if you look at what has been deleted from the earlier one, you will see there is only one clause. Managerial remuneration part is the only clause removed because now it comes as part of the secretarial auditor's duty. Now, just these are a couple of important points before I get into the clause by clause. And then also the other point is that, earlier there was no need for talking about the reasons to be stated for unfavorable or qualified. Now, where in the auditor's report, the answer to any of the questions referred is unfavorable or qualified, the auditor's report shall also state the reasons for such unfavorable or qualified answer as the case may be. And where the auditor is unable to express any opinion in answer to a particular question, the report shall indicate such fact together with the reasons why it is not possible for him to give his opinion. Him and her are to be read in tandem. So though the language used is him, I'm sure it's gender neutral about. So now, what are the matters to be included in the auditor's report, para 3? So this is just a summary of all the 21 clauses and a snapshot, and then we'll get into each of these over the next probably 41 minutes. So the first clause was already there. So to put it simply, the ones in black are clauses which were already there. And if it is amended, a comment has been added that it's been amended. So clause 1, 2, 3 amendments are there. Clause 4 is retained. Clause 5 is amended. 5, 6, clause 5, 6 and 7 are already there. 8 is a new item. 9 and 10 are amended. 11, 12 amended. 13 retained. 14 is a new item. 15 is retained. 16 amended, and 17 to 21 are all new items. And if you just look at 17 to 21, just on the face of it, you'd see that some of these clauses which have come in, I'll go back one slide also. A disclosure of transactions not recorded in the books. Look at that. Now we have to now talk about, the raid happening in a particular client location, and what has been found and what has been assessed and all that to ensure that that also needs to now find a place in the audit report. Internal audit system, very important, which was skipped in the earlier Caro, finds its place back once again. Talking about cash losses, not only in the current year, but in the immediately preceding year also, the cash losses, so that will now have to be worked out separately. What is the cash loss will have to be worked out separately, and that has to be reported on by the auditor. Resignation of auditor with reason and all of that, I'll talk about it in detail during that slide. Capability of a company of meeting its liabilities existing at the date of balance sheet. Now look at that. So it's going concern finds a place, and it's even talking about if there is any degree of discomfort that an auditor may have for any foreseeable reason over the next 1 year or 2 years, that also has to be reported in the audit report. transfer of unspent amount, that's the CSR element that we were talking about earlier. Now that is also forming part of our responsibility to ensure that, again, transfer of amount remaining unspent, as a problem. These are all words. Now, unspent is the definition, how it is to be spent. So when you just say unspent, we cannot just say that there is no unspent amount. We have to necessarily look at the working to ensure how it is spent. The manner in which it is to be spent has been specified. Accordingly, whether it is unspent has to be looked at. Only then can you decide what is unspent. For a reporting, when you need to do, we need to be convinced about, just because it is transferred somewhere or it is parked somewhere or it is just given as a CSR advance given for some project to somebody, whether that is adequate, it will need to be tested. So in short, the utilization of CSR funds in some form has now come into this report as part of our responsibility. And in years to come, it is going to be a huge responsibility. We are talking about phenomenal amount of money which is circulating in the system as CSR, large chunk of which is being diverted either for political reasons or otherwise. So much we know, we are seeing so many large corporates which are receiving requests from, if it is within the local area, we can at least have somebody to take a look at it and see. But sometimes for the larger companies, they are under pressure from places which are so far off in some other part of the country and some other state somewhere, sometimes in the northeast and all that. So sitting in all of us sitting in the south, it becomes difficult to know. Has this been spent for this project in Guwahati or Arunachal Pradesh? How do we have a mechanism? Earlier, we didn't really need to worry too much, but now we need to. So we need some fellow professional there to look at it and certify it for us. We need to get that done. And we shouldn't stop from giving, that kind of, work support to another professional brother or sister sitting somewhere else. It's a good way for all of us in profession to, find this as a new area of work. Obviously, we are not able to get there. We connect with somebody there, give them some work and work together. And over a period of time, we network with them. They have something back here and they give it to us. And so overall, it helps the profession and it helps everybody. It's bringing in transparency into the way in which CSR funds are, which is really important. The largest amount of money which is being diverted out of the system in the last 3-4 years is through the CSR route. So that's something which I think will get tightened with this. And finally, the CFS also, sometimes what we see is that, some of these companies have a large number of subsidiaries and some comment there does not really find a proper full disclosure with reasons and all of that does not come into the CFS statements of the holding company. So now it's very clear what the auditor of the consolidation statement auditors, how they need to report is also now, that is also mentioned, which should come up in clause 20. Okay, so I'll quickly run through. Most of these things are things which we would probably know. Some of us would have already started applying our mind. Some of us have already completed some of these audits on it, and the reports are already finalized or signed already. But in any case, it's like in a classroom approach. Let's go through for the next half an hour on what was mentioned in 2020 Caro 2016. We are all signing day in and day out. So we know what it is, but again, the problem is since it's already 5-6 years old, probably in 16, 17, 18 and all that, we would have really applied our mind. But in the last 3-4 years, we would have taken it for granted. We'll probably ask our audit manager, is there anything substantially different from what has happened? All these things are there. All the positive comments are there in the previous year. And if there is anything negative or any discrepancy, we will probably focus on it. Otherwise, we'll just take it for granted. So high possibility that we have also, some of these clauses we have also forgotten. So it's a good time for us to brush up once again and on what was in 16 and what has changed in 20. First clause is related to assets, and the part 3.1 is the maintenance of records of PPE and intangible assets. Again, a new addition which has come in now, and we all know what is an intangible asset. Say 26. I'm sure we will be by now we've all figured out what intangible assets are. AS10 has also changed, and so the nomenclature is moved from fixed assets to PPE. Schedule 3 everywhere now. What we use is PPE. So first clause is more or less the same, just the term fixed assets moved to PPE, and additional clauses regarding intangible assets. So we now need to report whether there are proper records. So software or whatever else which we've been amortizing over the years. Now we must ensure that proper records are there, licenses and all of those things which are connected. So in a way, what has sometimes been happening is some part of CW, some part of expenses get booked as capital work in progress. And some of the assets which cannot really be used or which need to be written off sometimes are just capitalized as intangible assets. And if you look at the books of some of the companies, you will see that there is an item lying in the asset schedule called intangible assets. And if you actually go there and verify, there'll be nothing. We all know what has been happening there. So now all those things are getting cleaned up. So if it's an intangible asset, it needs to be a real intangible asset. You cannot create some software work in progress and all that and keep it there for years. We've seen that sometimes. Software work in progress. 3 year, 4 year, it will remain as work in progress, and then we just get capitalized as some in-house software developed. And show us, please exhibit and show us what this is. Can I have those lines off the screen, please? Somebody with the marker. Yeah. So this is what, when you look at it from an intangible asset space, you must understand that now it's part of our audit methodology to ensure that it is there. Because even otherwise, we had the responsibility, but now we have the reporting responsibility also. So makes it stronger. And next sentence is the same. Next clause hasn't changed, just the term has moved. Now, these are 2 new clauses related to assets. Whether the title deeds of all the immovable properties, other than properties where companies, lessee and lease agreements are executed in favor of lessee, disclosed in the financial statement held in the name of the company, and if not, there is a format which has been prescribed by. So this is another important matter. Because sometimes we see some footnotes, which say that in some companies, we see that below immovable property, some star and some footnote saying that the title is immovable property is not being registered in the name of the company, but steps are being taken. Good, at least the company and the auditors were doing that disclosure properly. But in many cases, such disclosures are not there. But in reality, title deeds would not be in the name of the company. We've seen that, especially in many cases where we come in, where the auditor was moved, and then we first time audit, when we look at it and all that, the title deeds we find sometimes are not in the name of the company. And that's again, it becomes difficult for a bank. Bank is relying on certain documents, and the collateral security and all that is based on that. And say again, sitting as a bank auditor, when we see that when an account becomes NPA, and when they try to actually take action on the collateral, so many cases where banks are not able to act on the collateral because the title deeds have not been are not in the name of the company, or all of that. So many issues are there. Now the auditor will also be fixed if there is such a problem. So that's important. Next point is regarding revaluation, whether the company has revalued PPE or intangible assets or both, and if so, whether the revaluation is based on valuation by the registered valuer. Specify the amount of change. Change is 10% or more in the aggregate of the net carrying value of each class of PPE or intangible. So again, this is a new disclosure which has come in related to revaluation. And the last point related to asset is on Benami. Again, look at the responsibility which is coming in. Whether any proceedings have been initiated or are pending as a company for holding any Benami property under the Benami Transactions Prohibition Act and rules may infer. If so, whether the company has appropriately disclosed the details in its financial statements. So these are all things on which now we will have to definitely include in our letter of representation and get proper representation, but it will not just end there. We cannot just say that, management has represented and all that. We also need to have our own audit methodology for all of these things. Now, Benami, yes, probably, we can rely to some extent unless we have some information. Otherwise, we may have to rely on the management representation. But if I go one slide behind and I'm looking at clause number C, whether title deeds of immovable properties are in the name of the company, we cannot say that we have obtained a representation letter saying that all title deeds are in the name of the company. That will not suffice. We have to audit it. We have to have our own audit procedures to ensure that title deeds are part of it. Now, how do you do it for a very large entity? So last evening, I signed off on the balance sheet of a very large bank, which has almost 1,000 branches. Large number of title deeds would be in various parts of the country. Now, what are we going to do if we have to put in a clause like this? Of course, bank has a different. I'm just picking up a case of a bank, but then it has a different format and 11E and 11F and all that have to be complied. But if it is in the case of a large listed company, again having thousands of locations all over the world, how do you do this? So we have to come up with audit methodologies. May not be able to do 100%. We'll have to decide threshold. We'll have to bring in materiality. We'll have to bring in, for like we do for any area of verification, or we'll have to outsource this activity, get it done by respective internal auditors or concurrent auditors who are sitting in the respective locations, get them to certify it, and based on that, like we do for any branch auditor. So we'll have to place a reliance on the certification from their side. So we'll have to figure out, each of us here, we'll have to figure out it's something new. So we'll all have to collectively figure out what we are going to do for compliance with each of these. Inventory, again, very, very important. Earlier, it was Caro, we would see whether physical verification has been conducted at reasonable intervals and whether any material discrepancies were noticed, was the earlier Caro. It was for us to decide what is materiality. Today, it's no longer in our hands. New Caro has put a threshold of 10%. So there it goes. So whether physical verification is done and whether in the opinion of auditor, coverage and procedure of such verification by management is appropriate, whether any discrepancies of 10% or more in the aggregate for each class of inventory, not that even aggregate won't do. You do for FG, you do for CWIP, you do for raw material, you do for packing material, whatever else is in inventory. For each category of inventory, 10% test to be done. That's it. And look at B here. Whether during any point of time of the year, company has been sanctioned working capital limit in excess of 5 crores in aggregate from banks or financial institutions on the basis of security of current assets, whether the quarterly returns or statements filed by the company with such banks, sometimes it may be even monthly, quarterly or monthly or weekly or whatever it is, the statements filed by the company with such banks or financial institutions are in agreement with the books of account of the company. If not, give details. Now look at that. And it says sanction. So it's not the closing balance or availed balance. Sanctioned working capital limit in excess of 5 crore in aggregate from all banks and institutions together. And the security has to be current assets. So security is, if it is unsecured or if it is secured on fixed asset, another, I needn't consider that. But security is current assets. Then the statements made, which basically means that sometimes when we do the branch audits or head office audits, our largest debate is on this. Some statement is being sent, and when you compare the book debts and inventory stock and book debts balance as per the statement furnished by the company, it will be 10 crores. In the balance sheet, it will be 3 crores. Now, drawing power is reckoned based on 10 crore. Now, as auditors, we will rework it based on 3 crore. When we rework it based on 3 crores, there is no adequate drawing power, and we'll say it is NPA. Then they will come and tell us, no, sir, it is not like that. In the audit, they have actually shown a lower figure for tax planning. This is one explanation. Second explanation, they will say that in the bank statement which they have given, they have considered some other outstanding orders which are manufactured, but in the location here, location there. Now stock audit is insisted, and then the stock auditor goes there and he finds that half of these stocks are not there. He will also give a report saying that as per stock statement, it is only 6 crore. Then bank will again say, no, the day the stock auditor went there, main person was not there. So he did not look at one go down. He did not see some other location. See, we've all been through this. We are all continuing to go through this on a regular basis. We are hearing this discussion from the banks, and we don't know. We are not sure whether the balance sheet is right, or whether the statements are right, or whether the stock auditor's report is right. We don't know. How are we to know? But now all that onus is now put on the auditor. Now the statutory auditor has to also look at quarterly statements or other returns, whatever filed with the bank. So look at the amount of added work which is coming in. I'm just trying to highlight that. The amount of time we feel that we are working hard and not able to, not being in many cases not even being adequately compensated for the time that we have to do for additional compliances which have come over the years. And now we have so many new things coming. So it's also important for us to ensure that our client understands that, if it took us 3 weeks last year for audit, this year it's going to take us 5 weeks, which basically means that our costs are going to go up by another 30-40%. So this awareness has to come. They cannot say, no, this is your problem. I don't know, it does not help my business. This is something your institute or MCA is saying. What is my problem is what the client will say. But we have to ensure that we are billing for the time we spend. Next is regarding repayment of investments, guarantee loans, etc. And there the clause, not much of a change. But the point here is that whether during the year company has made investments in, provided any guarantee to or security or granted any loans or advances in the nature of loans. So the applicability of it has been enhanced. If you look at it earlier, there were loans secured or unsecured, partnership, etc. That part is fine. Here, look at how much the purview of it has been expanded when you say investments provided any guarantee or security or granted any loans also need to be brought under the ambit of this verification when we do this. And clause A remains the same. And clause A sub A goes on to include subsidiary, joint venture, and associates also. So again, these are all clauses which we need to read very closely and we need to understand. I'm not getting into every clause here, but then see whether now here you say parties in the register maintained under 189 of the Act. Whether this register under 189 of the Act itself is being properly maintained. So we are here certifying in Caro that these are all done and all that, and somebody goes there for a review or the ROC man goes there and parties are there, everything is there, but you can't even find a register under 189 when he goes there. This is the problem which the ROC tells us when we have some meetings. And recently one of our ICA events here where ROC was here, Sri also attended that couple of weeks back. So he was saying this. So many things which are there in the report and nobody's applied their mind on it. Auditors are just signing off without really giving it adequate focus, was a comment which he made, which is a very serious comment coming from an ROC. Continuing with this, these clauses remain the same, just a few additions here. So I'm not really getting into this particular clause, and this is important. I thought I should spend some time on this particular clause. Whether any loan or advance in the nature of loan granted which has fallen due during the year has been renewed or extended, or fresh loans granted to settle the existing overdues of existing loans given to the same parties. If so, specify the aggregate amount of such dues renewed or extended or settled by fresh loans and the percentage of aggregate to total loans. What a responsibility it is on us. Basically, what they say is this is to crack the problem of evergreening of loans. What is evergreening? An account which is fallen due or which is, which needs to, from looking at it from the other side, fallen due basically means within 90 days it becomes NPA. On the 89th day, it is renewed or extended or a fresh loan is granted. Just to ensure that this account does not become NPA, some additional facility is given to save this account from becoming an NPA. This used to be a big problem for us when we do the bank audits, where we say that we'll have a large list of accounts which we feel are SMA2 accounts which have been, which the bank has granted some facility to ensure it doesn't become NPA. And other the bank will argue, saying there was a fit case or there was a new project, or there were new fresh, stock and debts which have been given, additional security given. They will argue, and whatever is acceptable, we would take it. It's not that every facility we would say needs to be removed and all that. But generally an ad hoc limit given without any additional data, just an ad hoc limit is given to rescue an account from becoming NPA. It's something which we would want. That would come either as some fresh funds or some other party, some transfer coming in from a related party, or some TOD which is given. Some different instruments are there in banks. But then all of that, we need to worry about it only when we do a bank audit. Now we need to worry about it sitting here as statutory auditors of our client. You must understand that responsibility is now put on the statutory auditors. Whatever we write there, if we write something here, then the bank will look at it and take action there, or any regulator for that matter. So this is something we must keep in mind, and we must understand what this clause is and why this clause is coming. And the next point I'm not getting into. 185, 186 will not, no change there. Respect to loans, investment guarantees, whether provisions have been complied with, if not, provide details thereof. So it remains the same. No, it remains the same, but it's a very, very tough one here. So let us not underestimate this provision. This is one which has created a lot of trouble for all of us over the last few years in drafting various comments when we have seen some movements between these parties mentioned in the compliance with the provisions of 185 and 186. I'm not getting into it because those sections have also evolved substantially over the years. The initial 185, 186 is very different from what it is today over the last 6-7 years. There have been a lot of amendments in those sections as well. Moving on to deposits. Earlier, it was only talking about deposits accepted by the company. Now, deposits accepted or amounts which are deemed to be deposits are also covered. Again, not getting into any of this because this is a section which we've all been following, but understand that it's not just deposits now, amounts which are deemed to be. So that test will have to be applied whether any amount can or should deemed to be a deposit. If so, 73 to 76 and all of that, we have to ensure that there are no contraventions therein. And if an order has been passed by the CLB or NCLT or RBI or any other transactions, whether the same has been complied with or not. So dangerous area, acceptance of deposit rules and all of that. We've always been struggling with identifying whether an amount is a deposit or not is something we've always debated on sometimes, but a lot of clarity has come in over the years. So now this is deemed deposit is also brought into this. No change in the cost records provision. The maintenance of cost records has been specified by government under subsection 1 of 148, whether such accounts have been made and maintained. This is another, that made and maintained is something which a lot of people have not fully understood. So we need to critically understand made and maintained. Both are a reason why could just have been say whether they are made, or they could have said or just maintained. It's made and maintained. It's a thin line, and there have been issues where we've had to discuss on this. And here again, we must see whether it is actually applicable. We need not write on this everywhere. Not everybody is covered under this. Sometimes we've seen reports where cost records are not mandatory, but then it's not there, and then but some comment is written by the previous auditor, or we see that the records are made and maintained. You go to the company, there are no records. So when there are no records, but the auditor of previous year has said, then we'll say, where is it? It's not there. But then when you look at the, that it's not mandatorily required. So it's not there. The auditor should just say it is not there because it is not mandated. But, without application of mind, they will say, yeah, records are made and made. Okay. Now moving on, again, I see some lines and dots on the screen. I hope the marker can be turned off, whoever is drawing the lines. Now, statutory dues. No change really, except that between 2016 and 2020, GST has come in. So the clause has been amended whereby GST is also now included in the undisputed statutory dues as on the last day for a period of more than 6 months. That needs to be listed out, and that's something that we've been doing, and that continues. And again, the last para in B, a mere representation to the concerned department shall not be treated as a dispute. So we must understand what these are. And B talks about any dispute, and sometimes we find that all kinds of things are sometimes written in audit reports. So we should also understand we have a Caro document, there is a guidance note, and there are certain things which are mentioned in it which need to be applied with. We must understand if an item is a dispute or not. Some test has to be applied, and any professional who applies their mind will be able to know whether it is a dispute or not. It should not just some junior in the system, some article assistant list down some, particularly go to a large hospital, there will be a lot of disputes. Somebody would be filing something there or putting up some complaint there, or all kinds of things there. I'm talking about regulatory. It's concerned with the regulatory matter. There could be so many things that are in industries like that. let us say, there are several sections which are applicable to certain industries. Since I spoke about hospital here, some hazardous wastes, there is some problem. Somebody related to pollution has, put up a complaint. A random complaint goes that some waste is being disputed, and something comes up, and some department will, probably ask for some information or so, and some replies. Right? Is it really a dispute? Dispute is created by some individual who's saying something, but from a statutory due angle, is there really a dispute? Is there really an amount concerned here? The point here is whether statutory dues referred to and surplus have not been deposited on account of any dispute, then the amounts involved and forum where dispute is pending shall be mentioned. And clearly what are undisputed dues, including, it's all listed there. And then you find something completely unconnected which is lying in the audit report. These are things I'm telling you because we've seen some of these things. So some degree of that's because the student who has gone for the audit may not have understood what is a statutory due, does not even know what is the meaning of statutory, does not know the meaning of the word due, does not know the meaning of deposited, does not know the meaning of dispute, and then brings out something in a list, and then it finds a place in the audit report. The report is not the place for all that. Whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year. Again, I spoke about this earlier. So some raid or some activity that some money, undisclosed income that has either been voluntarily or otherwise been paid, and not whether that has been recorded is also part of the duty of the statutory auditor. Moving on to default and repayment of loans or other borrowings, whether the company has defaulted in repayment of loan or other borrowings, then there is a certain format needs to be filled in. And in B, the company is declared willful defaulter by any bank or financial institution, needs to find. And how do we know? How do we know whether the company we are auditing is a willful defaulter? There are ways. There is something called the CRLIC report. When you do the bank audit or large company audit, you can see that. You get access to that, you will know which are the companies, and through the CRLIC report, you can know if somebody's a fraud account or a red flagged account or a willful defaulter and all that are there. So we must also understand and look at and figure out. For all of these, we must have our own verification methodology. We can't just by the end of the year, board meeting is over and some audit manager brings a Caro saying that company is not declared a willful defaulter. You can't just sign off on that. If it is a willful defaulter and you sign saying it is not willful defaulter, your certificate is at stake. Now this is very, very serious. Next few, I'm not really reading each of these. But what we are talking about is that the onus of establishing whether funds have been diverted is coming squarely on the auditor. Term loans are applied. If not, the amount loans so diverted and purpose may be reported. Whether the fund raised on short-term basis, long-term, whether taken any funds from entity or person to meet obligation of subsidiaries. The company has raised loan during the year on pledge of securities held by its subsidiaries, joint ventures. So look at that. So loan diversion, again, this is all from a larger economy's perspective that they're looking at it, from the nation as a whole, banking sector as a whole. From any of this is some money being taken out and being diverted. So they don't want any more Vijay Malyas or Nirav Modis, and so they're expecting that the auditors have to. Is it easy for us to do this? Are we in a position actually to assess if something is a diversion or a genuine requirement? Are we capable? The board decides that one is a very cash-rich company. They have a subsidiary which is not doing well, and they are investing some money in the subsidiary to take up some new project or to improve that. It could be a genuine transaction. Is it diversion? And now that subsidiary money is diverted to subsidiary, and the subsidiary finally becomes a bankrupt. Money is gone. Does that mean that it is the holding companies it's a fund diversion? Is it a genuine fund diversion? I mean, is it a genuine fund transfer for a proper regular project, or is it a diversion? These are tests. So again, our judgment is going to come in play. A lot of documentation will be needed for us to establish that it is not fund diversion. And if we think it is, we should report it. There are no two ways about it. Let us be very clear that we should not in any manner try to hide anything. The remote possibility is there, that is reported. We have already many things in large companies. We have to give key audit matters, and already our responsibility is so high. Anything and everything. If we find that we need to even if it is not there in any of this format, we have to bring it in CAM. But now over and above CAM, so if we suspect a loan diversion, we are expected to bring it in CAM anyway. Apart from that, we also need to specifically answer these questions. Very, very risky and dangerous. We need to tell ourselves that. Regarding IPO, FPO, etc., there is no change. So I'm not really reading that. It's the same clause which we've all been signing up on. Fraud. There was a lot of resistance when this came first in 2016, saying why as auditors we go back to the whole watchdog definition that we've always learned, and why should an auditor get involved in reporting on fraud? And that's a forensic man's role. And I remember at that point there were a lot of meetings where ICI had taken up saying that we don't want to report on fraud in these, but MCA felt otherwise, and owner says, in a way it's good, so let it come. So if there has been a fraud either on or by the company, by employees or officers, etc., it needs to be reported, and that's fine. They have now gone on to add 2 more clauses. Whether any report under subsection 12 or 143 of Companies Act has been filed by auditors in Form 884 prescribed with the central government, and whether the auditor has considered whistleblower complaints, if any, received during the year, which means that we need to say we have considered whistleblower complaints. And here we're talking about large companies which may have thousands of whistleblower complaints and RTIs against the company and all that. And we need to say that we have looked at those, and if we have a problem there, we need to report. But are we in a position to say if it is genuine or not? And will the company really, there is some random, let us say there is a whistleblower complaint against the managing director of the company, alleging some harassment and all that. Are we really in a position to say whether this is a genuine complaint or otherwise? We don't know. So we are saying whether the company has considered the whistleblower complaint. What do you mean by considered the whistleblower complaint? Are we to sit in judgment? These are questions which we will need to address. I'm telling you, this is going to be very, very difficult for us to come, especially in complex clients. These are going to be difficult. Nidhi companies, AB remains the same, and the C clauses, whether there has been any default in payment of interest and deposit or repayment thereof for any period, also details. 177, 178, not getting into it. Again, clauses which we've discussed a lot during the years. Related party, very, very complex discussions have happened on the matters there. A lot of documentation which we've all insisted from these companies. Not getting into a discussion, it's a whole discussion chapter in itself. Now, internal audit system is extremely important, and I must say that wherever we are statutory auditors, even if it is below threshold of Caro and all that, we should insist on having a proper internal audit system, either internal or otherwise. Ideally, let it be a system which is done by another chartered accountant, rather than them employing some junior MBA or somebody like that in the internal audit system. We don't want. We need it to be done professionally. That's also a good opportunity for, again, all of us in the profession to grow, because it's only people in our profession who can actually get a holistic view of things. You can have a technical person do an engineering audit or a pollution audit or something. You can have a medical person do the health audit, or power saver audit or energy audit can be done by an expert. But the way our profession is and the way we've all been trained, we get a full picture. We can do not only the financial audit, but we can also do the system study, we can do the value addition part, we can do cost reduction, we can look at process improvements, because that's the way in which our training has happened over the years. So you must insist, in my opinion, that wherever internal audit system is not there, to do it, and wherever internal audit system is there, please tighten it. If you and I are sitting as statutory auditors, personally, I think that a large number of these things in this new Caro and in the earlier IFC and all that should be in the internal audit checklist, should be in the internal audit scope and engagement. And they have to necessarily report on it quarter or half yearly at least, not beyond that. No annual and all that. It should be ideally quarterly, if not at least half yearly if it's a small company. And let it all come out. Let them look at all this and do it. Wherever we are statutory, we will get them to do it. Wherever somebody else is statutory, let us do it. If we are auditors, internal auditors, let us tighten up. It is good for us as internal auditors, because tomorrow, God forbid, if there is a problem, if there is a fraud in the system, all these auditors are going to get caught, irrespective of the scope and all that. Nobody is looking at all these things anymore. Nobody is seeing whether it is in the scope or did you. If there's a problem, everybody connected to it. First, you arrest the MD and the full-time director, then the next the CFO and the finance manager, then the statutory auditor, then the internal auditor, then the concurrent auditor. Everybody is seeming to be colluding to a problem. At that point, finally, we can all say that, no, it is not there in our scope, this is not there, that is not there, and all this tamasha when it becomes some case and all that, you can argue, but at the end of the day, everybody is seen as being hand in glove if there is a problem. So let us consciously, if a statutory auditor, if you feel that the internal audit system, there is an internal auditor who's paid, but he's not doing his job, call them, have a clear sitting with the management and the internal auditor, and every quarterly or half-yearly meeting, statutory auditor must be present. And when this internal audit report is being presented, statutory auditor must comment on it and say that please look at this, please look at that, please add this in your scope. So that by the time we are ready with our statutory audit, let us have a very, very watertight internal audit report done by a fellow professional with whom we can also place reliance on. And their internal auditor will also be thankful to us. They may also be doing it in a relaxed manner. We are now going to tighten it up, and in turn, we will convince the management that the fees, if it has to be increased 3 times, 4 times, it has to be increased 3 times, 4 times. You cannot, you pay, if you throw peanuts, you get monkeys. No, that's the way it is. So if you need a good professional, you need to necessarily compensate accordingly. That's the importance of internal audit. Moving on to some of the other clauses, non-cash transactions with directors, again, very serious matter, but there's no change in the provision, so I'm not getting into it. And registration with RBI, earlier we had that 45 IA of the RBI Act, and so whether the registration has been obtained, that was where it stopped. Goes on now, saying whether the company has conducted any non-banking financial or housing finance activity without a valid, that is something which we are seeing sometimes. People do this banking kind of business without really getting registered under RBI. They have found many cases. I'm aware, sitting in some of the meetings in RBI and that names, I know some of the large companies also have done some of these transactions, which will be perceived to be of a non-banking financial nature. Similarly, where the company is a core investment company, let's say a core investment company, for example, or Tata Sons is a CIC. So as defined, that's like an umbrella company. There's defined regulation RBI. So whether it continues to fulfill the criteria of the CIC, and in case the company is an exempted or unregistered CIC, whether it continues to fulfill such criteria, whether the group has more than one CIC, if so, how many? So there are sometimes, why should a group have multiple CICs is the question. So that needs to be, it could be again complex arrangements between some companies and all that. So that also needs to come out now in the Caro. And whether the company has incurred cash losses in the financial year and immediately from previous financial year, so state the amount of cash losses. That's also part of the Caro now. Resignation of statutory auditors. I think this is again very, very dangerous. I tried to speak about it when I spoke earlier, and first time that it finds a place in Caro. So the new auditor needs to write why, where, how, when, what, all these things have to now come in, where whether there has been any resignation, if so, whether the auditor has taken into consideration the issues, objections, or concerns raised by the outgoing auditor. So we are now going to have to, certify that I have taken into consideration the issues, objections, or concern raised by outgoing auditor. So the outgoing auditor, we have to write to them, not just for an objection, but with all this, we need to write to them. And if they give you a list of concerns, then how do you address it? Sometimes the auditor may have had a problem with the management. That could be the reason why they left. And out of their sheer anger towards the management, they may write a lot of objections and concerns and send it to you. We have no option but to not take cognizance of it. So these are all things which we will need to figure out in the year ahead. So understand the gravity of some of these observations here. Now here comes another new one, wherein going concern also is going to be certified in a much more with a lot of data. We must analyze the going concern, so to say, on the basis of financial ratios, aging, expected date of realization of financial assets and payment of financial liabilities, other information accompanying the financial statement, the auditor's knowledge of the board of directors and management plan, whether auditor is of the opinion that no material uncertainty exists as on the date of the audit report, the company is capable of meeting its liabilities within the existing at the date of balance sheet, as and when they fall due within a period of 1 year from the balance sheet date. Now look at that. Look at all these things. It's one sentence if you read it. There is no full stop between this here. Such a long paragraph sentence here saying so many things. And imagine the amount of responsibility that is cast on us, especially in cases where some of these companies are borderline companies which could go this way or that. Very healthy companies is a different story, but here look at all of what we're going to have to certify in the class levels. Moving on, CSR. Again, it's another altogether dangerous game that we are playing here. CSR is, the most, everybody's in the economy. When you talk about people, the fund diversion, so to say, in the economy, people will all tell you that CEOs will tell you, I'm not comfortable with the way my money is being spent, because 2% of, let us say, a company which makes 5,000 crore profit has to spend mandatorily 2%. Sometimes the board fixes 2.5%, 3%, and all that as threshold above the 2%. And these people who are there have to take responsibility for projects which are happening in some part of the world, somewhere in some part of the country. Some of these independent directors may be from some places which nobody's ever heard of. And they will insist that some money should be spent in their constituency or in their area. And 15 crore, 20 crore is spent on building some housing project there or some toilet project in some village and all that, with the help of some NGO partner there. And for large companies, there will be hundreds of such projects going. If it is only 1 or 2 projects, fine. You can also, this company can also put one person or a team to once in a while go inspect all the projects happening all over. Responsibility is huge on them, and now that responsibility to some extent comes on us when they say in respect of other than ongoing projects, the company has transferred unspent amount of funds specified within a period of 6 months or so. Whether any amount remaining unspent under subsection 5 pursuant to any ongoing project. This ongoing project, what is an ongoing project? That itself is something can be ongoing for 10 years. Some little progress would be there. Is that enough? But sometimes you will see that a company has its own trust. Transfer to the trust, that's enough for CSR spend. But is the trust spending it properly? Or if not, the trust sometimes brings it back to the company after some time. These are things which are happening. So responsibility is huge when it comes to CSR certification. And the final point is related to CFS. There, the consolidation auditor has to see whether there have been any qualifications or adverse remarks by respective auditors in the company's auditor's report included in the CFS. If yes, indicate the details of the company, para numbers of the Caro report contains. Again, there will have a format there saying that in respect of subsidiary number 1, there is a issue in clause number 8, clause number 10, clause number 12, next one, whatever. So list down the name of the companies and the paragraph numbers containing the qualifications. And some of these companies may have hundreds of subsidiaries. We were central auditors of State Bank of India, and number of subsidiaries, their subsidiaries in every part of the world. Or again, ONGC, we were auditors some years ago, and ONGC subsidiaries runs into pages. So now we have to look at and bring all the adverse remarks there, the qualification para number and adverse remarks, wherever it is there, has to be highlighted, in the main auditor's report. So it's again, it's good. It's certainly good because sometimes there are skeletons which are hiding in the audit reports of some of the subsidiaries. So it is good that all those issues are highlighted in the consolidated final report. So that's something which was much needed, and that's been done. With this, I think I'll come to the formal close on my presentation. My mail ID is here in case any of you have any queries. I do understand there's another speaker coming in at 3:30, so we may not have time for Q&A, but mail ID, please feel free, Vivek Govind at varma@varma.com, varma@varma.com, and we can certainly have some. So I see one question here. Say, for example, on 31 companies, cash credit balance is 10 lakhs, sanctioned is 1 crore, drawing power is 10 lakhs. Our banker is insisting on stock and book debt statement DP of 1 crore. As on, kindly give your opinion. The company submits stock and DP with DP of as on 33. Okay, yeah, okay. I'm not going to get into all the number part here and all that, because I think you're trying to break down this. I'll just keep it very simple. When you look at it from a DP angle, it's not really, the sanction limit is not what we are looking at it, and when you look at it. But here, from the reporting angle, we have a responsibility of one thing is that the sanction limit is 5 crores. So the example you've given is so technically, whether whether it needs to be reported in Caro, it's really not required. But if voluntarily, if somebody wants to report it in Caro, this is only the threshold given. If even for amounts lower than that, it needs to be, you want to report in Caro, go ahead. I'm sure that's fine. But here the critical issue is that if there is a audited account which shows 2 crores, okay, that's not brought in here. So let me just bring that also in. See, the audited accounts here, you say the company's cash credit balance, you talked about all that. The critical issue here is that the audit report shows 2 crores. But the statement submitted, or let's say audit report shows 50 lakhs for this example, but the statement given to the bank is for 1 crore. So 50 lakhs is what the as per the audited accounts is, but in the stock and book debt statement it is going to be 1 crore. You need to report there is an excess of 50 lakhs. In short, I think I'm just keeping it simple. Anything that is reported over and above, if it is material, will need to be brought out in the audit. So that's about it when it comes to this part of it. Let me quickly conclude once again with my thoughts on bringing all of this together. I think the bottom line here is that it's coming down to corporate governance, and the role of auditors has become tenfold. Regulators, users of the document, who once upon a time blindly respected anything that we would give them, is today a little more suspicious, and which is probably why there are more clauses which have been added, so that now we cannot say that okay, we have taken a holistic perspective and all that. No such, you cannot take any holistic macro perspective. You need to specifically answer minimum questions, is what the regulator is today telling us, and the minimum questions have been specified. We don't have an option now. We need to go about it. So some of this we can accept with some degree of certification and all that, but any certification we take from management will need to be tested, will need to be checked, sometimes test checked, sometimes fully checked if there is discomfort, like we would for any other audit procedure. Caro will have to have our own very, very methodical, systematic program sheet checklist, which needs to be taken seriously. Most of our audit program sheets and checklists are not taken adequately seriously by our audit team. I think each one of us here, we are aware of that. We know that well. We all try our best to drill it into their heads, but we somewhere know that that is not being done to our satisfaction. So let us now use this as a whip to change that and ensure that program sheet and checklist, if you don't do it properly and apply your mind, don't come to us with this. As we need to be very, very aggressive to this. And overall, I think it is good. I must appreciate the efforts of MCA, NEFRA, and particularly our ICA. It would have been sleepless nights for our council members to ensure that that the documentation and everything is in line with the expectations of all these regulators. And let us hope for good days together under the new Caro regime. And probably a few months later, we can have another discussion to see what are the specific issues or difficulties which we faced. And that will also be interesting, purely interactive, where people just exchange views on what they have seen with the new Caro. 3:29 p.m. So I think I'll stop. I can see the next speaker in the room. Must respect that time. So thank you very much again to all the organizers for giving me this opportunity, and I someday look forward to being with you in person. Thank you very much.
Thank you, sir. It was really a wonderful session on Caro. In fact, you have really helped us in knowing how cautious we should be in handling the audit reports. Thank you. Thanks a lot, sir.
Thank you so
I
much.
now call upon CA Balaji to present vote of thanks.
Good afternoon, all. It gives me an immense pleasure to deliver the vote of thanks for this program to all members assembled here. I would like to thank our speaker, CA Vivek Krishna Govind sir from Cochin, who honored this session with his inspirational thoughts like CSR utilization, related party transaction and its consequences, and binary property and inventory verification and all is very superb, sir, and very explanatory in nature. I would like to thank our management committee members of the Chengalpattu district branch of SIRC and Priya madam and all the members participants for making this program a grand success. Thank you.
Thank you, sir.
Thank you. Thank you once again. Thank you.
Thank you.
Friends, now we move on to our next session on fraud risk in financial statements. We have a very renowned speaker from Kolkata, CA Vivek Agrawal. I request CA Kannan sir to introduce the speaker. CA Kannan sir.
Yeah. Happy evening to all. It's a great pleasure to introduce the speaker of this session, Sri CA Vivek Agrawal ji, to this August audience. Mr. CA Vivek Agrawal is a fellow chartered accountant and an associated company secretary. He has done DISA, forensic audit course, as well as IND-AS course from ICAI. He is the partner of Mrs. S.K. Agarwal and Company, Chartered Accountants LLP, heading IND-AS and forensic along with audit and assurance and giving opinion on accounting matters for scheme of arrangement and decoding complex accountings. He is specialized in assurance, having practical knowledge of IND-AS implementation and successfully implemented IND-AS in paper manufacturing, edible oil refinery, cement industry, and FMCG industries. He has successfully implemented standard operating procedures for many companies. He is a regular speaker on IND-AS, IFC, and standards on auditing in various platforms across India. He has been a trainer in training the in-house auditors of Department of Finance, Tripura State Government, Ministry of Finance Telecommunication, C&AG, East CAG. He is holding many important positions in various forums. To name a few, co-opted member in Sustainability Reporting Standards Board of ICAI, Special Invitee in Accounting Standard Board, Special Invitee in Auditing and Assurance Standard Board, Group Member in Drafting Forensic Accounting and Investigation, President of Association of Corporate Advisors and Executives, Convener of ACAE CA Study Circle, Executive Committee Member of Direct Tax Professional Association, Member of Study Group of East India, which is redrafting AS for SME in line with India, Life Member of Bombay Chartered Accountant Study Circle. He believes in knowledge sharing, and runs a blog in the name of www.vivekonline.com. With this brief introduction, I leave the floor for Sri CA Vivek Agrawal ji to enrich the knowledge of the chartered accountants, as it is a much sought over topic. Sir, I, on behalf of Chengalpattu District Branch of SIRC of ICAI, welcomes you, and the floor is yours. Thank you.
Thank you, Kannan sir. Thank you, Priyaji. And thanks to everyone. Thanks to my previous speaker who has raised the standard of the deliberation today. We have two Viveks today for Chengalpattu District Branch. So hope I justify the session after Vivek sir. And thanks to everyone, for my friends to Chennai, because I feel Chennai is my second home. So kunjam Tamil solunge, nalla inga yapte ke inga puringe and all. So I have learned Tamil a bit when I was in Natakan and I used to regularly travel to Chennai. So with this, I think today the topic is a bit important. It's a bit important because whenever we do a work of an audit, we always have this fear. The fear that whether we will be able to justify the work given to us. As Kannan sir was rightly saying, this Caro 2020 which has come, it has reposted a lot of responsibility to the auditor. And it was getting different because our auditors were always saying that how will we report all this? Therefore, most of the part has been covered in our Schedule 3. And now as an auditor, we have to report from Schedule 3 But it is also our prime responsibility that the data given in Schedule 3 are correct or incorrect to be checked. And when we talk about fraud or the fraud risk per se, our responsibility increases manyfold. With this, I would request all the people attending the session. We have 108 people. Please have your chat box active and keep on answering the question in between so that we will understand that there are people on the other side of the screen actually listening to us. And it would be better if your videos are on, we can see each other. We'll have the feeling of a physical meeting. Friends, when we talk about fraud risk, I would have an open question for all the people who are attending the session. You must have had a discussion on fraud reporting in Caro 2020 also. So what do you mean by fraud? Or how will you define fraud in a single term? Anyone in the delegates? How will you define fraud?
Can I say fraud is a wrongdoing?
Fraud is a wrongdoing. Anyone who can add that? Anyone who can add that? It is a wrongdoing, okay, but
there should be a bona fide intention. The intention of that particular person to defraud somebody or deny some kind of rights. A lot of things we can add up. There is no specific definition, but this may change according to the situation, according to the various scenarios. This is my view.
Perfect. I think that was very perfect or very apt when we talk about fraud. But friends, as an auditor, are we there to go and search for fraud? Is my work to go and search for fraud when we are doing an audit of financial statements, say, or when we are doing any internal audit also? Is it my role to search for fraud? Anyone, you can write in the chat box also.
Again, yes. I will say, basically, our motive is not to look into fraud, but any suspicious activities. Something which certainly tell us like we have to look into it, some kind of a substantive test we are supposed to do that. In that area, yes, it is must, and also statutory requirements. In some areas, if we are not going to get any proper response from the management, we have to report. This is my general opinion.
Thanks a lot, Anita ma'am. Anyone else? Yeah, Titaji said, no, as an auditor, we should not search for fraud.
Generally, we don't go with the assumption of investigation.
Continue, ma'am. I request the organizer to mute the people who is talking and unmuted by mistake. Yeah, continue. Someone was speaking over there. After Anita, ma'am.
Yeah, generally we don't go with the.
Yeah, Vitali, ma'am, you went unmute. Please unmute yourself.
Yeah, we don't go with the intention of investigation because that is a basic assumption is to go for an investigation. But if it comes in, if it comes across, right, then it is our necessity to, it's our thing to, we need to report for that.
Correct. So it is like when we are doing an audit, in between audit, if there is a fraud which has come, which has surfaced during the course of an audit, then a reporting requirement for fraud is there. But when we are doing audit itself, we are always afraid nowadays that whether the audit has been done to the perfection or not, and if a fraud comes out, what is my responsibility? I think this is a general fear in everyone, and therefore nowadays we say something that audit is more of a specialized job. Assurance is a specialized job. And it is not like when we have seen in say 10 years back, 15 years back, people were doing audit, and while doing audit, they knew that if I do audit, I will get a service tax consultation work. I will get a GST work. I will get a indirect tax work. But nowadays, if you are doing assurance work, if you are doing audit, you have to be relatively more stringent. You have to do something what I call proper documentation, so that whenever our assurance process, whenever our audit process tests the court of law, we are able to prove that we have complied with the standards on audit, because when we are issuing a report, we say we are issuing this report and we have complied with the standards on audit, correct? So anyone who can say quickly how many standards are there in audit? Because that is what we are certifying in most of the audit reports, that we have complied with all the standards. That is the report we give in SS 700. So how many standards are there in audit? Anyone quick answer? You can use your chat box also if you are not able to mute yourself or unmute yourself. Yeah, Krishnan. How many standards are there? Anyone, please use your chat box also. Have a fast listener first. We all are now used to this virtual system of working. The chatting has increased with WhatsApp. Anyone, number of standards in audit? Because whenever we are asked to prove that we have done our audit properly or not, and why this fraud didn't come to your notice when you have done an audit, then we have to certify or we have to prove that we have done the audit as per standards on audit. And first and foremost, we have to understand that the standards on audit are there and we are required to follow the standards. The prime responsibility of following the Ind AS, AS and other standards is first of the company. But to follow the standards on audit is the only, I would say the major part of it is to be done by the auditor, correct? So therefore I say audit not documented is audit not done. How many of you agree to this or disagree to this? How many of you agree to this? Please use your chat box. Anyone agreeing to this? Audit not documented is audit not done. Thanks for the confirmation, Vedhavali ji, Manasa ji. Others, out of 100, only 2 confirmations. So 98 are not confirming. We don't have to document the audit. Shruti ji, thanks for your confirmation. Rita ji, yeah. Friends, please make this what I would say. This should be the first and foremost thing we all should understand, and we all should follow. That audit not documented is audit not done. Because if we are unable to prove in the court of law that we have done audit properly, we will not be able to do anything. So what was the history of audit? When did audit first came in? When did audit first came in? It was at the time of Vishnu Kautilya, better known as Chanakya, who first introduced the concept of auditing in his book Earth Niti. And Birbal also, a great auditor for Emperor Akbar, gave him facts and solution on several complex matters with desired evidence. So it is not that the audit is a new thing. Audit was there since ages. It is just that we have kept the old wine in the new bottle. So this is the fear I was talking. If I don't document my audit properly, it may happen that my name appears tomorrow like this in some newspaper. So I'm really afraid to make sure or I am always upset to make sure that documentation is proper. So when I talk about fraud risk, what is the fraud risk? The possibility of the organization being subject to fraudulent activity. Risks of fraud can be existent within organizational operations also. So friends, why there is a fraud, or why a fraud happens? Why a fraud happens? Why a fraud takes place? Anyone taking a wild guess? We all have been in work. We all have ages of experience with us, decades of experience. So first and foremost, why a fraud happens? Opportunity. Perfect methodology. Opportunity. Anyone else? If I am given an opportunity to do a fraud can happen. Anyone else? Any wild guess? Poor control. Very good. Anyone else taking any wild guess? A business can lose significant amount of assets due to fraud. At an extreme level, the effect of fraud can even shut down a company. Consequently, a business owner should make ongoing efforts to create an environment in which fraud is less likely to arise. And that is why we have something called IFC, I suppose, my friends. Internal financial control. There are a number of factors that can make it more likely that fraud will occur or is occurring in a business. So what do you think? What are the factors that make it more likely that fraud will occur? If you all interact in the session, it will be better for both, that you will be able to have more to take home compared to others. So my humble request, if you all can interact. So why this fraud happens? Or what are the factors? Let's discuss some. Nature of items, size and value. If items that can be stolen are of high value in proportion to their size, such as diamonds, it is less risky to remove them from the premises. This is particularly critical item if it is easy for employees to remove assets without being detected. So the size and value of the item can be a factor for a fraud. Ease for resale. If there is a ready market for resale of stolen goods, this presents an increased temptation to engage in fraud. If there is a cash kept of say 1 lakh rupees and an item of say 1 lakh rupees, it is more likely that person will take away the cash compared to the item. Ease of resale or ease of use. Cash. If there is a large amount of bills and coins on hand or cash in bank, there is a very high risk of fraud. At a local level, a large balance in a petty cash box presents a considerable temptation to anyone who has access to it. Presently, today only I was in the board meeting of a large PSU bank. I am the central auditor for the bank. And we were discussing this point, cash in hand, at the year end. Because there was a holiday on 28th and 29th of this month of March, there was huge amount of cash lying in many branches where the cash collection is high. And the cash was not moving to currency chest. So I had this issue reported that due to high cash, there can be a good risk of fraud taking place. So there is a fraud risk for the bank. Similarly, when we see high cash at the at the teller machine, high cash at the cashier, there can be a good chance of fraud. Yes, Thagarajan, I'll take your question in due course. Separation of duty, what we have learned since ages, makers and checkers. The risk of fraud declines dramatically if multiple employees are involved. If there's one person in one of my clients I have seen, there was a single person who was signing the check, doing entry in SAP environment, and also having the right to online banking and receiving the OTP. So there is no maker and checker, there is no segregation of duty. It led to a fraud. The employee used the company funds for personal use, and good amount of cash was siphoned off. So, since fraud requires the collision of at least two people, the poorly defined job description and approval process presents a clear opportunity for fraud. And this is the basic principle on which internal financial control is also working. Safeguards. When assets are physically protected, they are less likely to be stolen. This can involve fencing around the inventory storage area. This is common physical access control. Documentation, we keep on saying the Caro also requires the physical verification of inventory, the physical verification of fixed asset, CPE. When there's no physical or electronic record of a transaction, employees can be assured of not being caught. If the fixed asset register is not there, employees know that if I remove one item from here, no one will touch me. So, documentation of the assets, documentation of the liquid assets is very important. Time off when the business requires its employee to take the full amount of allocated time off. This keeps them from continuing to hide ongoing cases. Therefore, this is the reason why most of the banks and corporates follow the concept of multinational companies follow the concept of compulsory leave. Recently, we had heard about this saga of Ashni Grover of Bharat Pay. He was first sent for the compulsory leave, and then everything was checked, and then it was found, as reported in media, that there was some fraud. Related party transaction we have learned since ages, post the Auditor Birla Committee of 2004, which brought in the related party transaction reporting in AS 18. When there are numerous transactions with related party, it is more likely that purchase and sale will be made at amounts that differ considerably from the market price. So related party transaction, if there's huge amount of related party transaction, there can be a chance of fraud. Complexity. When the nature of a company's business involves very complex transactions, and specifically one involving estimates. When we say about estimates, say a company is very asset intensive. So a company has to make the estimate of useful life. High estimate requirement. So how the estimates are made, the basis of estimates has to be checked by the auditor. A company is very employee intensive. So how the actual valuation is done, the requirement of the actual valuation, what are the information being taken for the actual valuation. All this complexity leads to fraud. Dominance, when a single individual is in the position to dominate the decision of the management team, and especially when the board of directors is weak. When the management, the CFO, the CEO, they are very powerful and the board are weak, the independent directors are weak, it can lead to fraud. Turnover, when there is a high level of turnover among management team, when the management teams are keeps on changing. This is also one of the reasons which is given in SA 570 for going concern. How to check for the going concern? This is one of the important reasons which says that if the management is changing every now and then, there can be a question on going concern of the entity. Auditing. If the company's high internal audit functions is not there. That is the reason why the internal audit, the nature and the size of the internal audit department has to be discussed in Caro 2020, and whether the auditors are having access to internal audit reports. Level of dissatisfaction. All those were the factors. Now there can be pressure. If the workforce is unhappy with the company, they will be more inclined to engage in fraud. disgruntled employees. Expectation. When there's a pressure from outside investors to report certain financial results. We were having a discussion very few days back with some of the CFOs of the leading companies. I had asked this question with the CFOs. You're having a dual role. You have to give a true and fair view of the financial statement. You have to make sure financial statements are fraud free. And you also have an expectation. Shareholders, management, directors expect from you that you give a very good result. This can lead to fraud. As someone was really asking a question of ILFS, DHFL, this expectation thing was also an important factor. And the owners or members of the management has guaranteed company debt. In Caro 2020, you were discussing that the managements are required to give the DP statement, and we as an auditor are required to check the current asset as disclosed by the management to the bank and those which are in my books. The guarantees, when the owners or members of the management have guaranteed companies debt, there will be strong pressure to report certain financial results in order to avoid triggering the guarantees. So there is a pressure to give a good DP. There's a pressure to overstate the stock debtors. There's a pressure to underreport the creditors. That is the pressure for reporting or doing a fraud. So friends, these were the major areas. I would again discuss in detail the ones which we have discussed just now. What do you think apart from this can be a reason for fraud? Any other thing which you have in your mind? Please use a chat box or unmute yourself. See, me coming and just speaking, going will make no sense for most of you. So it will be better if you can also participate in this company law workshop and have a better benefit from the session. So anyone having greed is also one of the important factors. Correct. Tyagarajan ji was asking in DHFL, Yes Bank, ILFS, how auditors missed to find out the fraud. My friend, auditors' work was never to find out the fraud. Auditors were there to do audit. Auditors were there to document what they have audited. If they are able to prove that they have done audit as per standards in audit, then no one can catch the collar. If they have taken a positive confirmation from the customers, if they have taken positive confirmation from the vendors, if they have taken proper confirmation from banks, and that is what we are going to discuss. Because the standards of audit is very particular in regard to fraud in many cases. There is a requirement in Companies Act also to report about fraud. So how to safeguard ourselves to make sure that fraud reporting happens properly, or if a fraud happens, no one catches my collar. No one catches my collar, and we are safeguarded. This is the normal audit procedure. We all know that when we are doing audit, we have to follow the compliance procedure, test of control, and we have to follow the substantive procedure, test of detail, and analytical procedure. In test of detail, we have done the test of transaction like vouching and test of balance like verification. If I have followed this procedure and I'm able to prove in the court of law that I have done the vouching, I have done the test of control, I have done the test of details, I have done the analytical procedures, I have done the test of transaction, I have done the test of balances, no one will be able to ask me whether I am at fault, or if anyone is there to ask me also whether I was in fault, I'll be able to prove that the fraud risk factor was taken care of by proper documentation and walkthrough of the process. There are some assertions which is defined in SF 5. What are assertions? They are representation made by the management embodied in financial statement used to assess potential misstatement. As I was saying, compliance procedure are tests designed to obtain reasonable assurance that those internal control on which audit reliance is to be placed are in effect. And what are the assertions which are tested through compliance procedure? The existence, the effectiveness, and the continuity. And there is also something called substantive procedure, which we have discussed. Substantive procedures are the tests designed to obtain evidence as to the completeness, accuracy, and validity of the data produced by accounting system. And the assertions which are tested through compliance procedure are completeness, existence, accuracy, valuation, presentation. So how do we see existence? All these are important to cover the fraud risk in financial statement. So existence through stock count on 31st March, we check the existence assertion of stock. Completeness through cutoff procedure, we check completeness assertion of sales. Accuracy through test of detail of sales, we check accuracy assertion of sales. Valuation through NRV testing of inventory, we check the valuation assertion of stock. And presentation for usual of related party disclosure as per AS 18, we check presentation assertion of related party disclosures. I think till here there won't be anything. If anyone has any question on the slides which we have discussed, we can stop over here and discuss the question if any. And if we don't have a question, then either I am 100% clear or I am 0% clear. They cannot be in between.
Vivekji, I have a small question here.
Yes, ma'am. Yes, ma'am. Please.
So, to what extent does a management representation letter really protect us as auditors?
Truly speaking, 0%.
Okay.
See, when we say management representation, if you see financial statement which is prepared by the management, it is also the responsibility of the management to make sure that financial statements are prepared properly. Okay, but we are taking a representation. The representation will not make us, or will the representation will not give us the freeway or leeway to run away from my responsibility. We cannot say we have taken a management representation for the stock, therefore I had not done the stock count, or I had not done followed the procedure to see the existence of the stock. We cannot say that management has said that we have complied with all the accounting standards, we will not check accounting standards. We cannot say that the debtors and creditors are there if we don't take a positive confirmation. Mind my words, positive confirmation. Gone are the days when we used to say that we have sent the confirmation to the customer, they have not replied. If they don't reply me within 1 week, I assume the balance is same. My friend, today we are in digital world. What I do personally for vendors, the large vendors who are not sending me a confirmation, I ask my clients, so please don't do their next payment, stop their payment, and ask them to comply with the audit requirements, then only the payment will be made. And actually this has helped me in last 4 and 5 years. For debtors, whenever there is a sales requirement, whenever the debtors ask for the goods, they are requested to send the confirmation along with the sales order or the requisition which they send me. Bank confirmation, 101%. Direct confirmation from the bank with the CC to the company. And not only bank confirmation of the saving banks, CC, but also the FD statements. Most of us don't take the fixed deposit statement. We say that the fixed deposit receipts are there. That is sufficient. But those receipts can also be manipulated. So third-party confirmation is there for bank. We are asking the confirmation of the loans. We are asking the confirmation of the bank balance, saving account, CC account, current account. Why not for FD? Ask for the FD statement. See the interest accounting done by the company. Check the TDS accounting done by the company. Don't wait for 26 AS. If bank is confirming that you have a FD, so much is the interest which is amortized or accounted in your account, why can't we take the entry in my system? Why we have to wait for 26 AS? Not only that, we also ask our client to give me the calculation of the interest for the borrowings, for the loans. I'll give you a simple example. What happened in one of the client, how I detected a fraud. The person who was responsible to do the online transaction and was also getting the OTP, he had made the payment to some illegitimate payments were made to some party. And at the year end, or I would say that in the quarter end, he passed an entry in books, FD account debit to bank account. Therefore, the BRS was matching. Correct? As an auditor, when we have large companies or large accounts, we don't see one-to-one transaction of the bank statement and we tally with the books. Practically not possible. We mainly go for BRS. In the BRS, in the bank, the payment was made to XYZ. In my books, the entry was standing as FD or parked as FD. So BRS was matching. My BRS is matching, I'm happy. But if I don't take a confirmation from the bank, we will never ever be able to see that the FD was created. So statement in the bank showed me that this FD is not in existence. Then when we went to see in the bank statement when this FD was created, the entry was not found. So we were able to unveil the fraud. If we miss to take a positive confirmation and rely on the MR, will we be able to safeguard ourselves? So this can be the importance of the bank confirmation. I hope I'm clear.
Yes, sir.
Thanks a lot, Priyaji. So we were talking about the auditor's responsibility relating to fraud in an audit of financial statement. This is an essay 240. And you know, nowadays fraud is a very fancy term. And Institute has recently issued a forensic accounting and investigation standard. I was fortunate to be part of that committee and I have drafted 2 standards myself in those 2 years of drafting of the standards. Please go through those standards, really helpful. If I don't do a forensic accounting of fraud, reporting of fraud audit also, it will help me in the day-to-day audit. These are the terms which are discussed in Essay 240. Fraud triangle, factors causing fraud, fraudulent financial reporting, misappropriation of assets, auditor's responsibility. What is auditor's responsibility in relation to fraud? What are auditor's risk assessment procedures? What is auditor's response to assess risk of material misstatement due to fraud? When should an auditor consider withdrawal from engagement and obtain management representation? So MR is there, but it is the least important in my hierarchy. So let's start with the first topic, fraud triangle. What is fraud triangle, my friends? What is fraud triangle? Anyone?
Is it like opportunity? And we generally use it, read it as opportunity, pressure, and rationalization. That's what we studied in our class while we were taking this forensic course. That's a triangle we used to study for the examination.
Correct, Anitaji. Thanks a lot, Anitaji. So ma'am said 3 words. Before going to the 3 words, there can be error also, there can be fraud. And in this fast moving life, where we have a pressure to do the audit very fast, we many a time tend to forget that the people or the work is being done by people. And there can be a chance of error also. To mitigate those errors, we have internal financial control. And there's a very thin line between fraud and error. What can be a perception for one as a fraud can be an error for other. So anyone who can discuss the difference between fraud and error, what are the major difference? Any bullet points? What are the major error in fraud versus error? Major areas in fraud versus error differentiation. Yeah, unmute yourself, ma'am.
The intention behind.
Intention. Perfect, bang on. So fraud is an intentional act by one or more individuals among management. Those charged with governance, employees or third parties involved in the use of deception to obtain an unjust or illegal advantage. So fraud is intentional. It has the objective to deceive people. Use of deception. Why to deceive people? To obtain an unjust or illegal advantage. So fraud is a very broad legal concept. The auditor is concerned with fraud that causes a material misstatement in the financial statement. There can be two types of misstatement relevant to auditor's consideration of fraud. Misstatement resulting from fraudulent financial reporting. Misstatement resulting from misappropriation of assets. As discussed, fraud is intentional. Misstatement in the financial statement can arise from either fraud or error. So there can be misstatement due to error also. But the distinguishing factor between the fraud and error is whether the underlying action that results in the misstatement of financial statement is intentional or unintentional. And this becomes very difficult to prove that this act was intentional or unintentional. Fraud is a broad legal concept, my friends. The auditor is concerned with the fraud that causes a material misstatement in the financial statement. So fraud for us is the one which affects my financial statement. That is what we are discussing, fraud risk in financial statement. So fraud can be fraudulent financial reporting, misappropriation of assets. Misappropriation of asset can be misappropriation of goods and misappropriation of cash. So ma'am was discussing about the fraud triangle. Is an incentive or pressure to commit fraud, which may exist when management is under pressure from source outside or inside the entity. My MD has told me that you have to show me a profit of 500 CR. I am getting profit of 400 CR. I am overvaluing my income or asset because I was told if I achieve a profit of 500 CR, I will get a percentage, 1% as commission as a CFO of the company, or 1% incentive. So there's an incentive or pressure. And I got the perceived opportunity. What? The inventory which is there is valued at, say, 100 rupees per kg. The NRV of the inventory in the market is 150. So I thought if I increase the price of the inventory to 120, then also cost for NRV, whichever is lower, the cost will be there. I got an opportunity because there was a big gap in cost of inventory as per books and as per local market. A perceived opportunity to commit fraud may exist when an individual believes internal control can be overridden, for example, because the individual is in a position of trust or has knowledge of specific deficiency in internal control. As a CFO, I know that the stock valuation is done manually and the costing module is missing. So the manual work which is done in Excel sheet, I have a control of that. I know there is a gap in internal control as the costing module is missing, and I have the opportunity to override the internal control or to value the costing, and I can play with the costing. Individuals may be able to rationalize committing a fraudulent activity. Some individuals possess an attitude, I have to achieve for number 500. I'll get clapping. character or set of ethical values that allow them knowingly and intentionally to commit a dishonest act. However, even otherwise, honest individual can commit fraud in an environment that imposes sufficient pressure on them. I am honest, I don't want to do any fraud. The fraud value is 400. The value of the profit is 400. I am least bothered whether the profit is 400 or 500. But my MD is pressurizing me that I have to show to the board that I have made a profit of 500. So I'm getting a pressure from above. So pressure is there, opportunity is there, and rationalization is there. A simple example, there's a person who deals in cash. He knows that my owner is regularly withdrawing cash from the company for his personal use. If out of that, I am also withdrawing some 1 lakh or 2 lakh rupees per month, my owner will not know because for him I am withdrawing 10 lakhs. So I have an opportunity to withdraw. I am saying my owner is doing that, why can't I do? Rationalizing it. And I have a pressure that I have got this expense which is required to be paid. If I don't pay, my family will go. Is this fraud triangle important? Because whenever we talk about fraud risk, we talk about fraud triangle. So any question on fraud triangle, my friends? Either no one has understood or everyone has understood 100%. So which one is the option, A or B? No one understood A, B, everything understood. Kindly write in the chat box. And if no answer, then everyone has just switched on their system and moved on. After a good curd rice, taking a power nap. Because job becomes very difficult to have a session after lunch. You all are there with me?
Yes, sir. Yes, sir. We are all, sir.
Thanks a lot. Thanks a lot, sir. So fraudulent financial reporting involves intentional misstatement, including omission of amount or disclosure in financial statement to deceive financial statement users. So omission of amount or disclosure. In one of the balance sheet was noted that the company's account was NPA at the bank. The company was not providing for the interest on the loan taken. An auditor was also reporting that the interest on the loan has not been accrued because the company was not providing interest as the account was in. There was a question from ROC that Mr. Auditor, please tell me, company was not providing the interest and accrual basis of accounting was not done. And if we have qualified for that also, the fact and the impact of same has to be ascertained and disclosed. Manipulation of accounts. Detection of manipulation of accounts with a view to presenting a false state of affairs is a task requiring great tact and intelligence because generally management personnel in higher management cadre are associated with this type of fraud. And this is perpetrated in methodical way. The type of fraud is generally committed to avoid incidence of income tax or other taxes. For declaring and dividend when there are insufficient profit. To withhold declaration of dividend even when there is an adequate profit. Or for receiving higher remuneration when managerial remuneration is payable by reference to profit. So these are the threshold or incentive for committing the fraud. To avoid incidence of income tax, if I show high profit, income tax is there. For declaring dividend, when there is insufficient profit, I don't have profit, I have to declare dividend. My management has committed, so I have to increase the profit. To withhold declaration of dividend, when there is adequate profit. I don't want to give dividend to the shareholders. I want to retain the profit, so I will not show profit. If I don't show profit, I will not have to pay dividend. For receiving higher remuneration, already discussed in the example of the CFO. So there are numerous ways of committing this type of fraud. Inflating or suppressing purchase and expense, inflating or suppressing sales and other items of income, inflating or deflating the value of closing inventory, failing to adjust outstanding liability or prepaid expense, and charging items of capital expenditure to revenue or by capitalizing revenue expense. So fraudulent financial reporting often involves management override of control that otherwise may appear to be operating effectively. Techniques by which management override controls: recording fictitious journal entries, inappropriately adjusting assumptions, changing judgments, omitting, advancing, delaying recognition, concealing or not disclosing facts, engaging in complex transactions, altering records. So recording fictitious journal entries particularly close to the end of the accounting period to manipulate operating results or achieve other objectives. Inappropriately adjusting assumptions and changing judgment used to estimate like depreciation, moving from WDV to SLM, moving from SLM to WDV, having 4 units, 1 unit SLM, 1 unit WDV in the same compound, omitting, advancing, or delaying recognition in the financial statement of events and transactions that have occurred during the reporting period. I have got the income tax demand virtually or via mail on 29th, and the demand is very high. So I want to not recognize the income tax effect. Therefore, I am saying that whenever the demand is received physically, then only I will account for those demands. Concealing or not disclosing facts that could affect the amount recorded in financial statement. Engaging in complex transactions that are structured to misrepresent the financial position or financial performance of the entity. Altering records and terms related to significant and unusual transactions. So, yes, Sridhar sir, I will share the presentation copy with the organizer. You can kindly take from them. Misappropriation of assets. Whatever I'm discussing right now, Mr. Thiagarajan, you can get some insight of the fact how it happens. It involves the theft of an entity's asset and often perpetrated by employees in relatively small and immaterial amounts. However, it can also involve management who are usually more able to disguise or conceal misappropriation in ways that are difficult to detect, like embezzling receipts. For example, misappropriating collection of accounts receivable or diverting the receipt in respect of return of accounts to personal bank account. In one of the fraud case, as I was discussing, payments were made to XYZ. Amount was received online from a customer, but the customer account was not given the credit, and the payment made to unauthorized parties were set off with the payment received from the customer. So debtors account will be standing, BRS will get tallied, but there will be misappropriation of cash or misappropriation of debtors. Stealing physical asset or intellectual property. Stealing inventory for personal use or for sale. Stealing scrap for resale. Colluding with competitor by disclosing technical data in return for payment. Tomorrow my company is bidding. So what price we are bidding for? Stealing that data and telling my competitor that we are bidding at say 100 CR. You bid at 99 CR. You will get the bid as the L1 and getting a kickback from that party. causing an entity to pay for goods and services not received. Therefore, proper PO system, service order, work order system should be there. For example, payment to fictitious vendors, kickback paid by vendors to the entity's purchasing agent in return for inflating prices, payment to fictitious employees. Using an entity's asset for personal use. For example, using the entity's asset as collateral for personal loan or a loan to a related party. So my friends, we were discussing a very important point where we had touched upon fraud and error. So fraud in the form of misappropriation of goods is still more difficult to detect because fraud was always with the intention for malified intention. So detecting a fraud is very difficult. And if the fraud is at the highest level from the MD, CEO, it becomes more difficult, which we call as white collar fraud. For this, management has to rely on various measures. Apart from various requirements of record keeping about the physical quantity and their periodic check, there must be rules and procedure for allowing person inside the area where goods are kept. Goods can be anything. In the premises, it may be machinery. It may even be daily necessity of offices like stationery. The goods may be removed by subordinate employee or even by person quite higher up in the management. Auditor can detect this by undertaking a thorough and strenuous checking of records followed by physical verification of process. Also, by resorting to intelligent ratio analysis, auditors may be able to form an idea whether such fraud exists. We were doing a review of stationery item at various zones of a bank. We found that the check leaflets or the paper for checkbook and DD book, the consumption is 15,000 per year for the zone, and the purchase made by the zone was 1,50,000. So I inquired the zone, so why you have made a purchase for 10 years paper in one go? And there was no proper answer. So this had our red flag that this can be a cause which may lead to a fraud. Therefore, it is clear from the above that fraud deals with intentional misrepresentation. If it is a fraud, it will be difficult to find out. If it is an error, you can find out. Because for fraud, everything is orchestrated, or everything is planned. How we have to show the document, how we have to show the papers, how we have to account this. But if an error is there, it's unintentional, so it can be caught in audit. So intentional errors are most difficult to detect, and auditors generally devote greater attention to this type because out of long and sometimes unfortunate experience, auditors have developed a point of view that if they direct the procedure to discovering the more difficult intentional errors, they are reasonably certain to locate the more simple and far more common unintentional errors. If we search for fraud, we will get error. If we hunt for fraud, we will get error. But my friend, there's always a discussion whether we are watchdog or bloodhound. Although the regulators are now thinking us to be a bloodhound, but fact is we don't have the teeth to become a bloodhound. Therefore, we are a watchdog. Defalcation of cash. It can be inflating cash payment, suppressing cash receipt, casting wrong totals in the cash book. When the physical cash books were there, the carry forward was incorrect. Making payments against fictitious vouchers. Making payments against voucher, the amount whereof has been inflated. Manipulating total of the wage rolls either by including their names of dummy workers or by inflating them in any other manner. Casting a larger total for petty cash expenditure and adjusting the excess in the total of the detailed column. So this is how cash is defalcated. By suppressing cash receipt. scheming and lading. These are all ways of fraud. Amount received from a customer being misappropriated, also to prevent its detection, the money received from another customer subsequently being credited to the account of the customer who had paid earlier. So similarly, money received from the customer who had paid thereafter being credited to the account of the second customer, and so on and so forth. Adjusting unauthorized or fictitious rebates, allowance, discounts, etc. to customer accounts. Writing off as debts in respect of such balance against which cash has already been received but has been misappropriated. When the old debtors are there, make sure that the old debtors balance confirmation is taken. It may happen for those debtors the cash has been received but not accounted. Not accounting for cash sales. All these are for cash, but I keep on thinking of this in the bank also. Not accounting for miscellaneous receipts. Writing down asset value in entirety, selling them subsequently and misappropriating proceeds. Many a time I have this question, your fixed asset register is improper. Vivek, I am removing all the items with the zero value as WDV. No, sir. The asset could have got depreciated. It would be a laptop which was used for the 3 years, but the resale value of the laptop is still 10,000. So you can remove the asset only when it's discarded. Carry it at one value, carry it at 5% of the purchase price, but please carry in the system. And remove from system only once the asset is actually thrown out or discarded. Obtain reasonable assurance that financial statements are free from material misstatement, subject to inherent limitations of audit. Subjected to fraud deliberately concealed, so difficult to detect. But exercise professional skepticism. Please understand, if a fraud is done, and if the company as a whole, everyone in the company is involved in the fraud, as an auditor, you will not be able to detect the fraud, because everyone is making sure that you don't detect the fraud. Either you are party to the fraud, or actually you may not be the party to the fraud, still you will not be able to detect the fraud. But to prove that you have done your audit procedure, you have to do the documentation, because audit not documented is audit not done. And whether you followed all the standards audit, you have to have the checklist of the standards and make sure all the standards are followed properly. Whether it's for Caro 2020, proper initiative should be there. Whether it is for Schedule 3 and additional notes, whether it is for AS or Ind AS, whether it is for Companies Act compliance, whether it is for Factory Act compliance if required. Because remember, the standard says you have to make sure that you have complied with all the laws which has affected my balance sheet. So professional skepticism should be there, but my motive is not to search for fraud. My motive is to confirm that the audit is, the financials are true and fair, and it is, I would not say error-free, but I will give a reasonable assurance. I'm giving a reasonable assurance that financials are true and fair and out of error. It doesn't have any material misrepresentation, a material misstatement. So auditor's responsibility is to obtain reasonable assurance that the financial statements are free of material misstatement, subject to inherent limitation of audit, fact, and fraud, because it is deliberately concealed. Therefore, as I said, if it is deliberately concealed, it cannot be detected. So detection of fraud and error, duty of an auditor, as per SAP 240, the auditor's responsibility relating to fraud in an audit of financial statement. The primary responsibility for the prevention and detection of fraud rests both those charged with governance of the entity and the management. It is important that management, with the oversight of the TCWG, place a strong emphasis on fraud prevention, which may reduce the opportunity for fraud to take place. The management has implemented internal financial control. It is the duty to make sure that the important controls are there and working. Fraud deterrence, which could persuade individuals not to commit fraud because of the likelihood of fraud getting detection, likelihood of detection and punishment. It is written in the lifts of a retail store, whether it's in an Ampa Mall or in Express Avenue or City Center. This mall is under surveillance. It is a deterrence of fraud. It's a deterrence of fraud. This involves a commitment to creating a culture of honesty and ethical behavior, which can be reinforced by an active oversight by those charged with governance. You have a fraud policy. You have a policy that if a fraud is committed, what will happen to the person? An auditor conducting an audit in accordance with the SA is responsible for obtaining reasonable assurance. Because the SA 200 says overall objective of the independent auditor and conduct of an audit in accordance with standards of an audit. Owing to the inherent limitation of an audit, there is an unavoidable risk that some material misstatement of this financial statement will not be detected. But to make sure that we have followed the process, we should document that all the standards have been followed. The risk of not detecting a material misstatement from fraud is higher than the error, as discussed, because fraud may involve sophisticated and carefully organized schemes designed to conceal it, such as forgery, deliberate failure to record transaction, or inherent mispresentation being made to the auditor. Now, in the case where I was discussing that the payment was made to some people, and in the books, entry was created, FD account debit to bank, and I was shown a forged FD certificate in the system, or I was mailed a forged FD certificate. If I have a document that I was shown a forged FD certificate, I am better off than not having the document. If I'm able to prove a forged FD certificate was shown and fraud had happened, and suppose the requirement of the confirmation from the bank was not there in the standard, then I would have saved myself. But say I have not taken the bank confirmation, I don't have the FD certificate, I don't have anything to prove that on which basis I have approved these books of accounts. Then God save me. And with coming of NEFRA and in the disciplinary committee, non-CA or non-professional being there, suppose an IS officer, what we say in Hindi, he will be lucky ka fakir. He will follow the rule book line by line, word to word, verbatim to verbatim, comma, full stop. And if we are unable to prove that we have followed all the standards of audit, we will not be able to safeguard ourselves. So as discussed, fraud may involve sophisticated and carefully organized schemes designed to conceal it, such as forgery, deliberate failure to record transaction, or intentional misrepresentation being made to the auditor. Such attempts at concealment may even be more difficult to detect when accompanied by collusion. When number of people are there, if one person is doing fraud, the second person may catch, or the second person doesn't support, then it can be detected. But if all the actors of the board are there in party to the fraud, we will not be able to make sure that fraud is detected. So collusion may cause the auditor to believe that the audit evidence is persuasive when it is in fact false. The auditor's ability to detect a fraud depends on factors such as skillfulness of the perpetrator, the frequency and extent of manipulation. The degree of collusion involves the relative size of the individual amount manipulated and the seniority of those individuals. When a fraud was detected, I asked the person, so how did you slept with doing all this payment to outside party and taking that entry from one bank to another bank to third bank to fourth bank and creating an FD over there? The person said, the day in, day out, while sleeping at the night, I used to think how I have to square off this entry. So if it's a well planned and the skillfulness of the perpetrator is there, we will not be able to detect the fraud. And the risks of auditor not detecting a material misstatement resulting from management fraud is better than the employee fraud, because management fraud, too, everything is covered, everything is planned. Employee fraud you can catch at certain level, but management fraud, sorry. But we can safeguard ourselves, as I am keeping on, spite of repeating myself. Document. When obtaining reasonable assurance, the auditor is responsible for maintaining an attitude of professional skepticism throughout the audit. That's fine. So what are the fraud risk factors? Implement quality control procedure in every engagement to obtain reasonable assurance that audit complies with professional standards and legal requirements. Audit report issued is appropriate. We have discussed, again I'm repeating, significant portion of management compensation is represented by bonus, stock option. There is a high turnover of management council or board members. Frequent disputes with the current or predecessor auditor. The auditor keeps on changing every year. Unreasonable demand on the auditor, including unreasonable time constraint. Sir, I have given a books of accounts. Please give me audited balance sheet by tomorrow night. History of security law violation. Significant pressure to obtain additional capital necessary to stay competitive. My company requires capital or else I will die. So it is more likelihood that a fraud will be happening in my company. Large amount of cash, inventory characteristics such as small size combined with high value, high demand, lack of an appropriate segregation of duty, poor physical safeguard over cash, lack of mandatory vacation for employees. Possibility of fraud, discrepancy in accounting records, conflicting or missing evidence, problematic or unusual relationship between the auditor and management. Other. Discrepancy in the accounting record, as I said, transaction not recorded in complete or timely manner, unsupportive, unauthorized balance of transaction, last minute adjustment, evidence of employees' access to system, tips or complaints to the auditor, conflicting or missing evidence. I am asking for BRS, not getting. Sending. I have asked for 10 vouchers. I have received 9 vouchers, 1 voucher, sir, giving. I am asking for original, I am getting only a Xerox copy. So original is there in the godown, sir. I have to certify that the land are in the name of the company and there is no Medami property. So the land papers are there lying in the trunk, in the box, in the godown, which is too far. My office is in Metropolitan and the files are lying in Punmali High Road. Significant unexplained items on reconciliation. Unusual discrepancy. There is an intergroup balance. No one is able to reconcile the intergroup transactions. Large number of credit entries and other adjustments made to accounts receivable records. Missing or non-existent cancelled checks. Missing inventory. Physical asset. When I get the physical asset verification report, everything is perfect. No discrepancy for last 10 years. Too to be correct. Problematic or unusual relationship between the auditor. Now, this is an important aspect. Denial of access to records facility. Sir, I will not give you any copy of documents, sir. My business is very confidential, sir. You cannot take any copy of document from here for your documentation. Undue time pressure. Unusual delay by the entity in providing requested information. Sir, sending you details, sir, today morning, sir, today evening, sir, today night, sir. So send you on 2 days, sir. Not getting the details on time. Unwillingness to facilitate auditor access to key electronic files. Sir, you will not have access to my system. You cannot use Excel, Word, PowerPoint in the system. And unwillingness to add or revise disclosures. Sir, disclosure is final, sir. Don't change, sir. Every year we are giving the same disclosure, sir. Why new things you are asking? Reluctant to change. Unwillingness by management to permit the auditor to meet privately with those charged with them. No. The Director of Finance says, no, you will not meet the MD. You will not meet with the audit committee chairman. Whenever you go, please tell me. You will not surpass me. I will go with you. Accounting policy which are not in line with industry. Frequent changes in accounting estimates. So these all are the fraud risk factors in relation to financial statement. Now we have discussed fraud risk. We have got the basic understanding of the fraud triangle. We have discussed the factors which are there for fraud risk. But if there is a fraud, what is the reporting requirement? Section 143(12). If an auditor of a company in the course of the performance of his duty as an auditor has reason to believe that an offense for fraud involving such amount or amounts as may be prescribed is being or has been committed in the company by its officer or employee, the auditor shall report the matter to central government within such time and in such manner as may be prescribed. And if the amount involved is 1 crore above, is being or has been committed against the company by its officer or employee, the auditor shall report the matter to central government. The manner of reporting to the central government, this is the procedural issues. You have to report to audit committee, wait for a reply. If you don't get any reply or observation within 45 days, please report to central government within 15 days on the date of the receipt of the reply or observation. So you can just go through this. I'll share the presentation. Disclosure in the board report. This is an important factor which is the crux of whatever was in the previous slides. The previous slides used to say 143(12) read with Rule 13. Fraud involving amount of less than 1 crore, report to board or audit committee. Within the 2 days of knowledge, report the following method: nature of the fraud with description, approximate amount involved and parties involved. And then disclose to board report. The disclosure in the board report. Disclose in the board report disclosure of following details again: what were the fraud reported and what were the remedial action taken or not taken. And if the fraud is for more than 1 crore, report to central government. Within 2 days of knowledge, report to audit committee. Seek a reply. If the reply doesn't come within 45 days, if reply is received, forward report and with reply with comments to central government within 15 days of receiving the reply. If reply is not received within the stipulated time, forward report plus note containing details of report for which failed to receive any reply or observation. Caro, the new Caro has come, so I'm not discussing, it was already discussed. Auditor's risk assessment procedure. Professional skepticism: do not take client integrity and honesty for granted, and audit evidence obtained suggests possibility of material misstatement due to fraud. Do not take client integrity and honesty for granted. And discussion among the engagement team: discuss susceptibility of financial statement to material misstatement due to fraud, how and where. Experienced team members share insight. Evaluation of fraud risk factor: inquiries of management, inquiries of employees, inquiries of internal auditors, inquiries of TCWG, in-house legal counsel, ethics, chief ethics officer, chief risk officer. All these are the new CEO, CRO, which are there in the large companies. You talk to them. So that was all from my side. If anyone has any question, I'll just be ready to take. Anyone having any question, my friends? Fraud is such a difficult topic, nothing was understood. No.
Sir, I guess unless you have some really practical experience on fraud, probably it is real niche area.
as I said, Priya, as the banking fraud which I was saying, it was a practical experience. It was a practical experience where people had actually siphoned off the cash, paid to the people from whom he had done betting, and then created a FD for that. Secondly, it was found in some of the retail chains nowadays where people, what they're doing, they're having a sale of cash and showing as a Swiggy sale, Zomato sales. And the difference stands on reconciliation at the end, and when the reconciliation are done, then the frauds are unearthed that so much payment was not received from Swiggy, who actually pay in 15 days. So why the payment was not received? Then because it was a large chain, the fraud amounted to 15 CR. Then we had also discussed of the fraud of the kickbacks is general, which was there since ages. Fourth, it happened that the management, whenever the billing was happening of purchase, a bill was taken of the larger amount. If the amount quoted was say 100 rupees, 120 rupees bill was taken, and 120 was paid to the vendor, and 20 was taken in cash by the management for speedy money for whichever income tax department and other factors it was there. And the purchase person came to know about it, and then he started taking the kickbacks, and the broker thought it is going to the management, but actually it was going to the person himself. So all these are practically which frauds are there. But again, fraud is not a thing like a thumb rule that this is a fraud or this is not a fraud. So fraud, what I have seen, fraud can be very, very challenging. It differs from the company to company, and it's a perception of a person, how he deals with it.
True, very true. In fact, when we see a lot of lodgings and boardings taking place in hotels, we see that when we do a online booking through a my trip or book my various other sites, we see that once after we reach there, the there are so many managements or hotels who convince the visitors to cancel the booking, and in turn make different bills. Yes, absolutely.
Then I've shared the PPT also in the chat box. You can download from there.
Sure, sir. We will definitely share it to the participants.
So anyone having any question? Or else the fraud was a very heavy topic after Caro 2020, and I was unable to justify it at time given.
No, sir, not at all. Absolutely. It was a wonderful session. Could you throw some lights on any specific scams which have happened recently? Fraud
scams, Satyam, we all know, it is more about the banking fraud, where the confirmations were not taken. Actually, the FDs and all were overstated. So as I was saying in my due course of the discussion, that we should make sure we take 100% confirmation. We take 100% confirmation in banks, case of banks. In the case of customers, vendors, maybe it is not practically possible to take 100% confirmation, but there should be a system in the company whereby company is taking the balance confirmation and having a reconciliation department which does the reconciliation. And as rightly said in Caro also, we have this transaction with the strike of company, all balance lying with the strike of company, investment done with the strike of company. This Caro is fully focused with the fraud. Strike of company. Next is your loan taken by the directors. What the directors do, they take the loan from the bank in the name of the company. Bank is charging interest, and directors takes interest-free loan in the name of themselves, in the name of their wife, in the name of their children, and then buy a property from those loans. So short-term loan, long-term loan used for the purpose for which it was taken. Loan to directors has to be reported in Schedule 3, which will help us, because nowadays this Schedule 3 has more qualitative disclosures. Benami property. The property will get an appreciation to company has taken the loan, and the director has taken the loan in their own books and purchased the property in their books. And thereafter, the land is rented to the company. So the director is having an interest-free excess of the money, taking money from the company as rental income and charging the interest which is being charged from the bank to the company. So the company's balance sheet goes for a toss, and the shareholders and the stakeholders are cheated. So, and this, whatever I'm saying, it may be in bits and pieces, but it will affect the financial statement if you see at a larger picture. Thereafter, stock becomes a big contention. You please have a look at the financial statements. Annual reports of various large companies used to come well in advance, but this time it will be delayed because of Schedule 3. The major aspect will be the reconciliation with the current asset details given. And mind you, my friends, it says current asset as per books of accounts. And if the company is in days, it should be as per in days. So valuation should be done as per in days. I don't know how many companies actually do a valuation as per in days and then share their stock statement to the bank every quarter, every month. And this we have to check and we have to report. Schedule 3, it will be there. And then in the Caro report, we have to report. It's a big challenge and it will actually unearth various problems. The DP statement, when we go for branch audit, has various deviations. This will be corrected as at the auditor's level itself or the company's level itself. So we won't get a overstated DP, understated DP, due to which the account goes to a fraud account or NP account. Diversion of fund is an important aspect. Current loan used for long-term purpose, long-term loan used for short-term purpose, and all this a vicious circle due to which the company goes for a toss. So it cannot be one stick for all, but we all have to have an open mind. We all have to start questioning for everything which is there in the books. We cannot take anything at the face value. I think that is the crux of all the auditors, all the financial scam, and we as an auditor should start doing our documentation properly, because audit not documented is audit not done. And if we are not able to prove in the court of law that we have done what we were supposed to do, and we are giving in the report SA700 that we have done audit as standards in audit, and if we don't have a basic checklist, I have a doubt whether it can be questioned that auditor has done fraud with the stakeholders, because we are reporting something which we are not able to prove, that we don't have a basic checklist. I am least bothered whether the checklist is of 1 page or 100 page. Something should be there first, and then fine tuning can always happen in due course. I think that will be a takeaway from today's session, that please start documenting. Please start documenting, and fraud risk will be there. Audit and assurance is a specialized job. We cannot take it at a face value. We have to become more focused. People keep on asking, Vivek, we don't get the substantial audit fees. So then we have to leave the assignment. You have to learn to leave the assignment, then carrying the baggage of the risk. And most of my senior members are there. I think they can also enlighten on this fact.
Absolutely well said, sir. In fact, sale of scrap is one more area. It's really always.
Priyaji, I would say sale of scrap is an area, but in many companies, still India has a system where we stay. This PD money, some cash is required at some department, and this sale of scrap and all generate those cash for the management. Many people are not wanting to do business in cash, but they are forced to withdraw cash for the departments. So, and this have actually reduced over time, and we can have a better tomorrow with that. And with this GST and all, where all my accounting books will be at the department site, I don't know whether how much it will be managed in future.
Any more questions from members?
So one more question, like for example, for giving the guarantees, right? Is there any other repository or central access where we can go and find out like this company has given any guarantee? Because if it is going to be a secured loan or unsecured loan, you have something in money which is coming or going out. If there's going to be something like an obligation, how do you go and find out that?
For guarantee, ma'am, if a company has given guarantee to a third party, the company would be giving a guarantee to its group company or others only. As of now, there is no repository as such. But if a company has a loan, or a company has taken a given a guarantee via a bank, that can be checked. But there is no repository in India as such. It will be, see, these are the areas where the MR will help me. But suppose we take a MR for the FD which is there. We have a third-party confirmation for that which is available. But for guarantee, if a third-party confirmation is not available, there the MR will help me.
Okay.
And we should also try and make sure if the guarantee are given by the company, ask the company to charge something for the guarantee commission also. Because one of the case, I got this letter from ROC that the guarantee was commission free. So this transaction is not at the arm's length transaction. Although I contested that it's a 100% subsidiary, so there is no transfer of funds as such. Holding company can give a guarantee to the subsidiary company, but and the proper documentation as per the requirement of Companies Acts were done. But still, I had to do a compounding for same.
What was the compounding for, sir?
The guarantee which was given, the company was not charging the amount, any amount for the guarantee given. So this transaction was prejudicial to the interest of the company. So why the auditor didn't report that this transaction was prejudicial to the interest of the company?
Okay. So we need to be careful in every way.
That's why I said, ma'am, assurance is a learning, and assurance has become a very difficult task. Very difficult task.
Right, sir. Any further questions? We'll definitely email you. You can address the same.
Anytime, anytime.
Thank you. Thank you all. I call upon Shri C.A. Anand to please present vote of thanks.
Good evening, one and all. The word fraud, normally to small, medium practitioners, the very next thing we get into is we are not conducting an investigation on it. That's not true. Vivek has explained us elaborately that non-detection of fraud, there is a risk associated with it, which has to be mitigated unless and until we follow the entire standards of auditing and we document it, that we have mitigated the risk to the maximum possible level, so that there is an element of non-detection of fraud is not there. There may be a thin line of difference between error and fraud. And when you come to the amount of changes that has been incorporated in Caro 2020 and Schedule 3, there are n number of red flags. Already it has been highlighted in this Schedule 3. For example, when we take the disclosure of quarterly stock statements to the banks, what we are given and the current assets as per the books of account, it is a clear red flag. If you miss that red flag, if we report it, say there is a huge difference between quarterly we have reported in Schedule 3 and what is the amount of caution and what is the amount of professional judgment we have made on the differences. If there is a huge differences, whether it is amounts to error or whether it is amount to fraud, all these are things to be properly documented and dealt with it. Unless and until we document it and we completely go through the entire standards of auditing and follow the recommended institute's recommendation, it will be difficult for us to defend ourselves in any other thing. And on behalf of the Chengalpattu district branch of SARC of ICAI, I thank Vivek Agarwal for bringing out these things in a very pleasant manner. And he has also ensured that the audit is not like having a Kolkata Rasagulla. It is something which is not so sweet. We have to take it in a different manner and so that our further professional practice is as smooth as eating a Rasagulla. And with this small gesture, I thank one and all present in there for attending this this session. And thanks you one and all once again, Vivek Agarwalji, for his wonderful presentation. Thank you.
Thank you, Anandji. It is not also very easy to have like a Mysore Pak of Krishna sweets.
Yes, sir.
Right, Vivekji, we will often call you, invite you to the branch. Please come down to our branch physically when you come here to Chennai. Sir.
Sorry, ma'am. Sorry, it will be pleasure will be mine because Chennai is my second home. In my articleship days, I have been there for around 2 years for audit.
That's
and
been
nice. In and out in Chennai. So I love going to Chennai.
You're always welcome, sir.
Thanks a lot.
Thank you.
Thanks you. Thanks everyone
Thank you,
and
sir.
the delegates for staying there till end.
Thank you.
Thank you.
Thank you, sir.
Thank you.
Yes. Friends, this power packed session continues till tomorrow as well. So tomorrow we have on recent regulatory mechanisms by ROC, penalties and late fees in MCA e-governance. I would recommend all of you to attend this program conducted by CA Kamal Garg, Delhi. Reason being, there are a lot of ROC notices which have been issued recently from various ROCs from Delhi till Chennai. So it is going to be very important for all of us as professionals to know how to safeguard ourselves. And there is a second session on exemptions to private limited companies and OPCs by CA S. Ramesh, Chennai. All of us can meet tomorrow. Please welcome for the session tomorrow. Thank you.
End session கொடுத்துருமா.